Welcome back to Real Estate Mindset. Today's video is going to be freaking crazy and it's going to be live, you guys. And what I'm going to do is I'm going to do several things. Let me know that my audio is good. Now, obviously I woke up super early. It's about, 5:50 a.m. One of the reasons why I woke up early is I have a lot of work to do today. Plus also I couldn't sleep because I've been so frustrated at the situation with all these bank runs. And I've been really frustrated, you guys, because obviously, you know a little bit about my situation. And, during the last, probably 2 years, I've been eliminating risks in my life. I've been making sacrifices so that I can prepare for the pain ahead and, obviously get ahead, financially in life. So when I see these bank bailouts happen and, taxpayer money go to supporting the ultra rich, and basically allowing those people to continue doing risky business and then they get saved, it frustrates me, you guys. So I kept asking myself, what does all this mean for real estate? How is this going to affect my journey and basically sitting on the sidelines? So today what we're going to do, guys, is we're going to talk about those things, and I have a plethora of things to go over with you. I'm going to try to take you guys through everything that has happened since basically Thursday. So I'm going to leave Silvergate out of this. We're just going to talk about Silicon Valley. We're going to talk about another bank in New York. We're also going to take a look at First Republic, who's down 70% right now after hours. We're going to take a look at the 10-year. We're going to look at the 2008 TARP program that was passed. We're going to look at Dodd-Frank Wall Street Consumer Protection Act, and we're going to look at, wasn't this supposed to be against the law? Weren't bailouts done? Right? So how is this happening? And it's very intriguing that this is happening over the weekend. And just to give you guys an idea, and I want to rant real quick, and then I'm going to get back to business, but just to give you guys an idea, roughly $25 billion is going to be set aside or bailed out, right, to lenders. And it's not just Silicon Valley. It's multiple lenders that will have access through a discount window to basically recoup. And to me, you guys, that defeats the purpose of what the Federal Reserve is doing. Now, I was sitting through the weekend, just really kind of proud of the Federal Reserve. And I actually had an entire live setup for you guys today that I was going to do about 8 a.m. It's completely butchered because I found out late last night that they're going to bail out these banks. So in other words, you guys, it's just really frustrating. At first, I was proud of the Fed. And I'm like, this is what fear looks like. We're finally going to have the unemployment. We're finally going to get the show on the road. And then they reversed it. So really crazy. But, before I get in, and I'm going to show you guys, what I'm going to, go over, I want to show you guys the 10-year. Take a look at the 10-year Treasury right now. Now, the 10-year Treasury, guys, is down 12 basis points. So I want to keep our eyes on the 10-year Treasury because obviously it's getting dangerously close to where we don't want it. So the reality of the situation is actually going to drop interest rates. That's not good. We don't want the 10-year at, around 3.5. That's dangerously low. We know that if, that 10-year goes to about 3.3, 3.4, whole bunch of buyers, well-qualified buyers, granted, right? And there's only so many of those, by the way, run back into the market. So I want to keep our eyes on the 10-year because, what we want is the 10-year to go up, right? So I believe the reason that 10-year is plummeting right now, guys, is a couple reasons. It's just crazy to me. But one of the reasons could be the market continues to fight the Fed. They don't believe that the Fed is, going to do the work that they're supposed to do. And why would the market believe the Fed when they're bailing people out? So the other reason is it's possible that the FDIC is selling the treasuries and assets that Silicon Valley Bank had in order to pay back the Federal Reserve for the $25 billion or whatever amount of money is going to be used to Silicon Valley. But again, you guys, let's keep our eyes on that. And I also want to keep our eyes on this right here. Now, this is First Republic Bank. First Republic Bank right now, you guys, is down 68% pre-market. So what I'm thinking here and what the market is thinking, so not just me, but also the market is thinking, one of the next banks to go down is probably going to be First Republic Bank. All right. It's probably going to go down. It's not really hit mainstream media yet, but it's probably going to go down. So those are the things we're going to keep our eyes on, guys. So remember, again, the 10-year is currently at 3.58. Let me write that down because I just kind of want to see what's going to happen as we get a little bit closer to market open. And First Republic is down roughly 70% pre-market. So like my man right here saying, I mean, it is absolutely bonkers. This is absolutely crazy, you guys. It's basically we've all been whiplashed again. This is obviously going to have an effect where there is more inflation. And here's the thing: the market's going to rally today. I can almost assure you guys, as a result of this, and as a result of the Federal Reserve pumping $25 billion back into the economy, right? Even though they're fighting inflation, even though they understand depression, stagflation, they understand these things, they still gonna pump $25 billion back into the market. So it is going to lead to more inflation. Plus, on top of that, the 10-year is dropping. I mean, this is a very, very crazy situation. Now, I'm just going to tell you guys right now, and I'm going to really get started here. I'm waiting for a little bit more people to log online. But good morning, everyone. Good morning. Totally lost my train of thought, you guys. I'm really just going to get started. There's just so much to say, and I'm going to do my, the best I can to really break this stuff down for you guys, basically step by step. So, in other words, basically what happened, guys, is the, FDIC took over, as you guys, let me pull up an article real quick. So as you guys can see here, all right, FDIC took over Silicon Valley Bank on Friday. All right. So it goes into a little bit about that. The Federal Deposit Insurance Corporation is in the spotlight this weekend. So I just want to point out that the $25 billion or 10% of the 2008 bank bailout was just authorized over the weekend. It was just authorized over the weekend. Congress didn't even meet to get the $25 billion. And I'm going to show you guys a little bit more of that as we move on here. But Silicon Valley Bank clients will be turning to the FDIC after a major lender of tech startups, struggled to maintain enough assets to assure depositor payback. So this is what I want you guys to understand, so far in what I am saying. So Silicon Valley Bank was not a normal bank, okay? Like Chase, right? Like consumers go to Chase, normal people go to Chase. Silicon Valley Bank was, and for lack of better words, was a rich people's bank. So in other words, the rich just got richer. And, here's the thing. Silicon Valley Bank basically invested in treasuries and other securities and bonds and things like that. As, bonds and the interest rates went up, they lost value on, the securities and the bonds, and they didn't have enough money to give back to the depositors who essentially was doing a bank run in Silicon Valley. But I want to point out, y'all, that this is a sign of things to come. This is showing us really the reality of the situation. And this is showing us the reality of commercial mortgage-backed securities. Okay. So this is kind of a commercial mortgage-backed security issue. Plus, on top of that, this is quantitative tightening working. So it's really, really shocking to me, you guys, the whiplash effect that has happened here. On one hand, good job, Federal Reserve. You're doing it right. We have a little bit risky bank going out of business. Hurrah, hurrah. And then the next thing we know, all of us have just paid for it. But that's not all, you guys. Take a look at this, okay? Look at this. Signature Bank. This was on Sunday. Also announced late Sunday. Again, I had a whole live I was going to tell you guys and talk to you guys about the housing market in San Jose and all this stuff. But late last night, the bailouts begun. But Signature Bank is closed. I just wanted to confirm that. According to this article, Signature Bank of New York is closed by regulators. This is the third U.S. bank failure in a week, counting Silvergate. I wasn't counting Silvergate before, but this is the third in a week. This is a sign of things to come. This is a result of quantitative tightening and as a result of deregulating. I don't know if you guys realize, but they deregulated back in 2018 some of the Dodd-Frank Wall Street Reform Consumer Protection Act. Because my first question was why? How is this legal? They made it legal in 2018. I'm going to get there in a second, but this is really, really crazy. Now, what we're seeing here with Signature Bank is crypto disaster. Crypto has been an utter disaster from the very beginning. Well, actually not from the very beginning. If you got into it at the very beginning, you probably made a lot of money, but everyone else that got into it lost a lot of money. So here is a little bit about Signature Bank. Signature Bank, one of the two big U.S. destinations for crypto companies, has been closed by New York regulators. All depositors of this institution will be made whole, the Treasury, Federal Reserve, and Federal Deposit Institution Corporation said in a joint statement. So, again, I don't get it. So risk. So these lenders, Signature Bank, Silicon Valley, are doing risky lending. When you take risks and something happens, most of the time, things naturally will penalize you. More risk, more reward, more penalty, right? But what this is showing, what this bailout is showing is these lenders, especially these small lenders, continue to do risky lending, because if you do risky lending and you do have a bank run, the FDIC got you, right? They got your back. So again, this doesn't even make sense to me. So instead of us being safe, y'all, instead of you and I, the taxpayers, being safe, they're keeping the rich safe and these risky investors safe. Do y'all see this? Do y'all see the collapse in commercial mortgage-backed securities? I mean, we've already the first black swan. I'm so sorry, guys. It's pretty early right now. I have a lot going on in my head because a lot has happened in such a short amount of time. But the reality is, we are having bank bailouts right now. Now they're hiding it. They're acting like it's not coming from taxpayers, but we're not foolish. And I'm going to show you guys again the 2008. What happened in 2008, but the thing is, going back to Silicon Valley, this is a massive, massive event, y'all, because this is the second largest bank failure in U.S. history. The number one, I don't know if you guys can guess it. Comment below. Let me know if you guys can guess what was the number one. It's crazy. And I actually had a bank account back in the day when this bank failed. Do you guys know what the number one bank failure was? Let me see if you guys know it. Comment below. Let me guys know. I'm going to tell you guys about 5 seconds. Comment below. What was the number one bank failure in U.S. history? WAMU. It was Washington Mutual. Yeah, you got it, Carlos. Washington Mutual. You guys remember that? But anyways, you guys, so this, though, Silicon Valley Bank collapse marks the second biggest bank failure in U.S. history. So there is no doubt, you guys, this was a massive problem. And really what the Fed is telling us that they're trying to do is calm down people. Right? That's their excuse for bailing out the rich. That's the excuse for spending our money on bailing out the rich. And remember, you guys, if you're like me, you are on the sidelines, you're renting, you have money you can buy, but you're eliminating risk because you want to get ahead, right? We're doing things the hard way. So when I see this, you guys, it's really a shot to the stomach, because it lacks accountability. It stinks. I have such small faith in the Federal Reserve at this point. And this is what I'm saying. Even though the market's going to rally, interest rates are going to drop, this is temporary. This is like a Band-Aid on a bullet hole. This is showing us the reality of of what these guys did. The low interest rates, the COVID money printing destroyed us. Not the higher interest rates. It was the lower interest rates that destroyed us. And unlike 2008, we had bank failure as a result of mortgage-backed securities, right? We have bank failure right now for many reasons: commercial mortgage-backed securities, low interest rates, the high interest rates, obviously the treasuries and bonds, becoming more valuable now, less valuable back then, and deregulation of the reserves that they have to carry on hand, which was normally 10%. It is now 0%. So a lot of stuff, you guys, but nevertheless, the Federal Reserve is telling us, and the Treasury was telling us, we got your back. We're going to save Silicon Valley. We want you to be confident in the banking system. But to me, it's not making me confident. It's making me less confident, because that was our money that needed to go to us if we needed to be bailed in or bailed out, right? It didn't need to go to the ultra rich. And I'm just going to give you guys an idea of the average deposit in Silicon Valley Bank. Okay, so take a look at this article, you guys, real quick. Let me just put it up like this. All right, so take a look at this. This is some good stuff here. All right, and I want you to pay attention to why I'm saying, Silicon Valley Bank was for the rich. It wasn't a normal person's bank. They bailed out the rich people again. Just like 2008, this is crazy. UBS analyst Erica, blah, 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 defended First Republic, pointing out that his average balance of consumer deposits is less than 200,000, okay? So this is First Republic basically saying, hey, we need help here. That's why you guys saw right here, it's down. Oh, look, it's rebounded a little bit. It's only down 55% right now. Isn't that great? But that's why it's going down, because First Republic is like, hey, we're in trouble. We need bailout. We need money. We're going to collapse, right? And they're saying, but it's okay. Bail us out because we're a more normal bank where the average deposit is less than 200,000. But Look at this. It goes on. With its business deposit average less than 500,000. By contrast, Silicon Valley Bank's average deposit balance, you guys ready? The average deposit balance, Silicon Valley, 1.1 million. Who has raise your hand if you have $1.1 million cash. I don't have anywhere close to that. And that was the average balance. Raise your hand. Seriously, has anyone got $1 million? Actually, don't say that on the chat. But my point is my God, that bank failure, ultra rich, right? And 92% of the bank deposit accounts have balances over 250,000. That means only 8% of the deposits for Silicon Valley Bank. You guys, listen to me. This is what drives me crazy. Only 8% of those balances should have been insured by the FDIC. Only 8%. Instead of the 8%, they're insuring all of the depositors, all right? Including, like I said, the ultra rich. Take a look at this, you guys. This is friggin' crazy, okay? Look at Roku. This is just Roku. This is really hard, okay? But Roku says 26%, Roku, 26% of its cash reserves are stuck in Silicon Valley Bank. And that, I believe, accounts for $500 million. So multiple companies were, putting their money in there. It got dried up. There's probably, 1,000 companies. These companies were worried about payroll. Hundreds, apparently tens of thousands, maybe hundreds of thousands of people were possibly not going to get a paycheck. So I understand the need to protect people from layoff and things like that. I just think that in this situation, guys, it drastically misses the mark and is just making the rich even richer at the expense of us. I see this costing us, not them. To them, it's like, hey, just continue doing risky loans. Do y'all see my point here? Do y'all agree with that? I mean, this is just crazy, you guys. But let's look at the 10-year treasury. So here's the 10-year right now. So 10-year sitting at 3.602. So it's rebounded a little bit. But again, this is not what we want to see. This is definitely not what we want to see. And this is the 3-month view. Look at this. Okay, so right now we're at 3.55, right? The last time we were this low was February 3rd. So we just lost, just so far, we've lost all of this work on that 10-year. Do you guys remember how excited I was when we were at 4%? I mean, how long did it make it at 4%? 2 weeks before it completely fell apart? Y'all see why I'm like, yeah, 4%. This is a black swan event for sure. This is 100% a black swan event. It's crazy to me that this is not getting the coverage that I, would have thought it would have got from mainstream. And I believe there's a couple reasons that is. You guys, number one reason is they don't want people to panic. And number two reason is at first the Silicon Valley Bank collapse, it really didn't affect the public. So when it doesn't affect the public, a lot of people, unfortunately, kind of aren't interested in it. But now that we're bailing out these rich people, it does affect the public. And I feel like it's really important that we keep our eyes on this situation because we're paying for it. And we're paying for it at a time where it's going to cripple us. We were fighting inflation, and now we've just added $25 billion. Isn't it just depressing, y'all? What if we didn't have to pay for the risks, the risk that we take and lost? What if we didn't, imagine how great investors we could be if we were just bailed out like that. I mean, it's just so depressing. But I'm going to tell you guys, trust me when I tell you, our self-control, us eliminating risk is not going in vain. We're doing the right thing now. This is just warning us of a bigger event coming. In my opinion, there's a bigger event coming. And again, let me kind of go, off a little bit here. So again, I keep asking myself, how does this situation affect my home buying process? And it does frustrate me because rates are going to go down at a time when buying demand is going to go up. So, because we're going into spring and summer. So we want the rates to be higher, not lower right now. So I think what's going to happen is anyone that goes back into the market right now is going to be paying the bill. I think that bill is going to be passed on to the current owners of these houses. I still, and the other thing, guys, this also reassures me that we can't count on the Federal Reserve. Tell me the difference of Jerome Powell and Ben Bernanke, right? I mean, they're both saying something and something else is happening and they're doing something else. I mean, at first I was like, yeah, Jerome is nothing like Big Ben. You know, it's nothing like Ben. But now I'm thinking like he's the same exact person as Ben. Whoever the chairman of the Fed is, they're just going to say things to try to keep us calm. That's what it appears to me until it completely collapses. And that's what I'm trying to tell you. This is, in my opinion, this is a trap. We're still breaking all fundamentals. In fact, we, in my opinion, just made it a lot worse. I was really proud. I had a completely different live setup for you guys, telling you guys how proud I was of the Federal Reserve. And I was going to look at San Jose. We're going to look at Sacramento. We're going to talk about how a bank collapse affects property values, local and nationally. But again, late last night, that was completely flipped. Let me keep going, you guys. Now, I'm going to talk to you guys about, just so we remember, the Emergency Economic Stabilization Act of 2008. So we're going to go into the 2008 Emergency Economic Stabilization Act. Now, obviously, you guys, that was included with the Troubled Asset Relief Program, or TARP, okay? So in 2008, TARP, again, Troubled Asset Relief Program. In 2008, TARP was passed, basically allocating or giving $700 billion. In 2008, do you guys remember this? $700 billion. Now, again, that was supposed to never happen again when we passed a little something. It was actually a massive piece of legislation called the Dodd-Frank Wall Street Reform Consumer Protection Act, right? It was supposed to ban bailouts. But what I found out, again, you guys, is in 2018, they reversed a lot of that. So we're going to go over that. But let me show you guys a little bit more detail for TARP, Troubled Asset Relief Program. So I'm going to read a little bit of this, you guys. This is pretty crazy. So again, going back to 2008, because this is what I'm saying, you guys. This is echoing 2008 to me. I'm sorry, there's still a comment up there. I'm sorry about that, guys. And I appreciate you guys' comments. Shoot some comments up. I want to answer you guys' questions here in a minute. There's a massive relocation of money. I mean, this is insane. But let me read a little bit about what happened in 2008. And then that way we can compare it to what was not supposed to happen right now. And that's why I'm saying, you guys, the Fed is garbage. We're in much worse shape than I think even I realize. I'm starting to think global depression. Stagflation. Inflation is going up. It's not going to keep up with wages. I see a global depression here. So it's really, really scary. But let me read some of this for you, you guys. I got to move this camera a little bit. I'm so sorry about that, y'all. All right. Hope that's better. Can you guys see me still? All right. Now, the Emergency Economic Stabilization Act of 2008, often called the bank bailout of 2008. And I'm going to show you guys, I'm going to remind you guys what banks got bailed out, how much money they were given, was proposed by Treasury Secretary Henry Paulson, passed by the blah, 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 signed into law by George Bush. It became law on October 3rd, 2008. In the midst of the financial crisis of 2007, 2008, it created a $700 billion TARP, okay, TARP, Troubled Asset Relief Program, $700 billion TARP. And we were never supposed, as taxpayers, we were never supposed to pay this again. We were never supposed to pay this again. So, you guys, but again, the $700 billion didn't just go to the banks. Remember, there was like a GM bailout and things like that. But the $700 billion Troubled Asset Relief Program to purchase toxic assets from banks. That's what's going on right now. Okay. The troubled assets are the security, the treasuries, the bonds. Those are the troubled assets. They're doing the same thing that they did back then. The difference is this. Let me explain this real quick and I'll get back to this. Okay, this is what they're doing. This is crazy. This is how they're selling it to us. They're selling it to us saying it's not a bailout, it's not taxpayer money, but it's the same thing. But this is what they're saying. Okay, so the Fed is going to print the money. First of all, okay? So how's it not a bailout from the taxpayers? The Fed is going to print the money. So here's what's going to happen. The Fed is going to print the money, but remember, FDIC is in control of Silicon Valley. So what Silicon Valley has said that, what the FDIC is going to be doing is selling their assets. So when FDIC sells the assets of Silicon Valley Bank, they're then going to pay back the Fed. For what? For bailing them out, right? With our money. They're going to pay us back. Or wait a minute. It's not our money. Whose money is it? Whose money is it? You guys, can you tell me whose money are we printing right now? But anyways, so that's the whole thing, you guys. FDIC is going to sell their assets. They're going to use the proceeds from those assets to pay back the Federal Reserve and however much money they take out to pay back the depositor. So when the bank opens today, all right, when the bank opens today, I can guarantee you there's going to be long lines around the block for people trying to pull out their money, right? That's going to happen today. So, stay tuned for that. But this is the same thing, you guys. Let me keep reading this. This is the same exact thing, okay? To purchase toxic assets from the banks. The funds were mostly redirected to inject capital into banks and other financial institutions, while the Treasury continued to examine the usefulness of targeted asset purchases, okay? It's the same thing. I'm telling you guys right now, it's the same thing. This is the same thing. All right, this is the same thing, but let me show you guys this. All right, let's pull up something else that I want to show you. Okay, so take a look here. Let me see real quick. Okay, so now I want to break down how much money actually went to banks in 2008. Okay, just so we know, because again, I told you the 700 billion did not go just to to the banks. Okay, so for the biggest part of TARP was the bank rescue. All right, which invested, and here's what I want you guys to think about with me. The bank rescue, which invested 200 hot. When did trillions of dollars become the normal? Anyways, $236 billion in over 700 banks. Now, interesting. Almost all of the investment has been resolved, most resulting in profit for the government although over 100 did result in losses. But I thought it was the taxpayers' money. Wasn't the taxpayers supposed to get that profit back? I mean, and wasn't that our money? You guys, but here's what I want to point out. Okay, last time around, 236 billion took an act of Congress, right? Huge piece of legislation passed. TARP was massive, right? 236 billion. Okay, again, 236 billion. Right now, they're setting aside 25. Okay, what that means is, like I said earlier, that means they have just approved over 10% of what was allowed, basically set aside from TARP. And they did that over the weekend for the ultra rich. How's that possible? I mean, is this not shameless to you guys? I mean, they're doing this. They're not even doing this behind our backs anymore. It's just they're doing it in front of our faces, and they don't care. This is the 10%. You guys, they've authorized 10% of what we got through TARP over the weekend without anyone's voting, right? Without Senate, without Congress, the House. Isn't this crazy? I mean, why do even regulations exist if people aren't going to force them? Why is the Federal Reserve telling us they're going to fight inflation when they're not? You guys, 10%. Again, let me just pull this up again. This is a big deal. Here's TARP, okay? Of TARP, Troubled Asset Relief Program, 700 billion. Of TARP, 236 billion went to the banks. 236 billion. And yet, we just gave them 25 billion. This is just really mind-blowing to me, you guys. I'm sorry I'm all over the place. I mean, there's just so much to talk about. I haven't even got through this whole thing, okay? But what I want to show you guys is just to put this in perspective. I'm going to show you guys the list of 2008. So I'm going to show you guys the 2008 list and what lenders took what amount of money, okay? Because again, 25 billion, that's a lot of money. But look at this, okay? I'm going to show you guys this. Okay. Here, let me zoom in for you. So here is the list of bailed out banks from 2008, starting with Wells Fargo. All right. What do you guys notice about the amount of bailout from Wells Fargo? Look at this, 25 billion. And Wells Fargo, you guys, that's a pretty legit company, right? Wells Fargo is probably responsible for a lot of the public holdings. So here's the thing I'm trying to say, okay? The fact that these risky, ultra-rich banks, Silicon Valley Bank, like who's heard of them up until recently, right? And a lot of people haven't, some people have. The fact that these risky startup banks are getting as much as Wells Fargo, I don't get it. I mean, I just don't get it. I just don't get it. Man, how depressing is that? But anyways, let me go back here, you guys. So there's Wells Fargo, then State Street, hot 2 billion. Look at even Bank of America. Okay, here's Bank of America. Only took, I say only, yeah, right, only 15 billion. So last time Bank of America took 15 billion. Look at Chase. Chase last time took a hot 25 billion. Okay, as much as Silicon Valley Bank, Signature Bank, probably, the other bank as well. But again, 25 billion for JP Morgan Chase. And I would argue that actually JP Morgan Chase, we need to stay in business. Silicon Valley, maybe not. And look at the next one, Citigroup. Unbelievable. 25 billion. Morgan Stanley, 10 billion. Goldman Sachs, 10 billion. Bank of New York, 3 billion. Okay, look at this, 3.5 billion. No one gets 25 billion except the top banks. So I guess what I'm trying to say is even though obviously last time, y'all, $236 billion went to bail out banks, that was to 700 different banks. And only the top banks got that much money, except Lehman Brothers. Obviously, Lehman Brothers didn't get nothing, and they got shut down. And the reason they got shut down is the bank said they didn't have enough assets to support being rescued, right? But really why I'm pulling this up, you guys, is I want you to understand the severity of printing $25 billion. $25 billion is just becoming a household name now. But the reality is that is a tremendous amount of money that someone's going to have to pay for that is drastically going to affect the inflation battle. And I think what's going to happen, you guys, is the Fed is just going to play this pity-patty game. They're going to possibly be weak until everything completely falls apart. And that's our big event. I think this is like a canary in the mine type of situation. Things are going to fall apart. That's when we get our crash. To me, even though I'm frustrated because I didn't sign up for this, I didn't sign up to help these rich people out. This is also reassuring because what this means is the quantitative tightening is working and it's starting to crack. The depressing thing is the Federal Reserve just scooped in and saved them, right? That's the depressing thing. I mean, I'm just being realistic, you guys. So let me show you guys this as well, okay? I'm going to show you guys Dodd-Frank Wall Street Reform Act stuff. Look at this, okay? Now, remember, this was supposed to be outlawed. We were not supposed to allow any more bailouts, you guys. There was no more bailouts. Look at this. From bailouts to bail-ins, understanding the Dodd-Frank Wall Street Reform Act, okay? So let me just read a little bit about this, okay? Let me zoom in for you guys because this is a total failure, and I just want you guys to know how we failed so badly. How is this even possible? That we're supposed to be protected? What the heck, okay? So here's how it was sold to us. Again, Dodd-Frank Wall Street Reform Act pertaining to bailouts. Let me read this to you. Above all, the most affirming stance this new law makes is that too big to fail financial institutions will not be bailed out by taxpayers' dollars this time around. Let's just pause a minute and let's just breathe that in for a second here, all right? Massive piece of legislation, by the way. And it's super depressing. Again, they did a workaround, this massive piece of legislation. They did the workaround on this over the weekend. Over the weekend, you guys. I'm just so blown away. Okay, but again, let me read this one more time. This is talking about the Dodd-Frank Wall Street Reform Act pertaining to bailouts because why is it pertaining to bailouts? Because we just gave them $236 billion. So the government's like, you guys, thank you for footing the bill on that $236 billion. It was actually $700 billion, but I'm just talking about the bank sector, $236 billion. They're like, don't worry, you guys, this is never going to happen again. We're gonna put it into law. Okay, I looked over, I glanced at this comment. I should not look at comments because it distracts me. I mean, I'm not really taking, not really, man. I'm not really taking, I know they're corrupt, but it's just like, you know what I'm shocked about? I'm going to tell you what I'm shocked about, okay? And I'm glad you made that comment. I'm shocked about they're just doing it in front of our faces. I'm shocked that people don't care. I'm shocked that people aren't caring about this enough to, like, where's the public outroar on this, man? That's what I'm shocked about. I mean, they're not even hiding it anymore. But I'm going to read this again, you guys. Above all, look at how passionate this is. Above all, the most affirming stance this new law makes is that too big to fail financial institutions will not be bailed out by taxpayer dollars. This next time around, it failed us. It failed us. And the thing is the bank wasn't even relevant to us. It wasn't a Chase. It wasn't a B of A where most of us keep our money. It's just some rich people's bank. Let me keep reading. In and of itself, this caveat alone smacks of prudence on the part of the governing officials. After all, it's no secret that the bailouts created one of the worst economic hazards for the helpless American taxpayer compared to any other financial reform to date. Okay? So these bailouts in 2008, this is what I'm saying, guys. Even though I'm frustrated and kind of heartbroken and really disappointed in the Federal Reserve, this is also signaling to us that there is a much bigger event at hand, and the situation is much worse. I mean, they met over the weekend to print $25 billion. So I hope you guys can see the writing on the wall. Okay, I hope you guys can see the writing on the wall. There's a bigger event. The Fed is just more than likely just going to lose complete control. And then Congress and the House and the Senate is going to have to get together, figure out some type of reform. Is centralized digital currency coming? Is this how centralized digital currency comes into effect? I mean, think about it. If we're in stagflation and they cannot do their job, are they gonna bring digital currency in? I don't know, but this is crazy. But again, bailouts created one of the worst economic hazards for the helpless American taxpayer. 2008. This is horrible. Compared to any other financial reform to date, in no way was a financial dilemma rectified. Therefore, protecting taxpayer money became the principal priority of the new U.S. reform. Isn't that interesting? So, seriously, guys, how depressing is that? I mean, do y'all it's crazy. We just have to do a really good job at electing people. We have to elect people that take laws like this seriously, that were designed to protect us. These laws were designed to protect us as taxpayers. And we need a natural correction here, not this artificial whiplash. This is crazy. This is Stacy. A lot of times I couldn't even see this, you guys. The whole digital currency thing, but now I see the way. I mean, if we have a total global depression, right? If we have a total global depression, CBDC, I can finally see that. Because I did not expect the bailout caught me by surprise. Silicon Valley Bank we're on the road to recovery, right? We're going to have our job loss. We're going to have a little bit of that fear. Banks were going to learn they can't just make risky loans, that you're not just too big to fail, be more conservative, don't lend as much, right? Cool down the inflation. We were winning, I felt like. So maybe here's another possibility, you guys, that I've been thinking about. Again, I think we're in worse shape than people realize. And I think that many banks are in a similar situation. And I reviewed Chase. And what happened here, guys, is essentially Silicon Valley had unrealized business expenses. People got freaked out because they didn't have, the depositors' money. They did a bank run. But that whole unrealized whole unrealized losses, it shed a light on other banking institutions. So I looked at Chase. You guys, let me say this real quick, okay? Chase right now, right? JP Morgan Chase right now, $44 billion in unrealized losses. Chase, $44 billion. And here's the thing. Some of these companies relied heavily on mortgages. Mortgages as low as it's been since the 1990s. They don't know none of that money, right? Even though people are buying, you guys, I'm telling you, half the nation's priced out. There's only so many. Don't panic. There's only so many of these well-qualified buyers. This is just a really crazy situation. Okay. So let's take a look at something else that's super depressing. I'm sorry, guys, but I got to talk about this. Okay. I'm not playing politics here. All right. I will never do that to you guys. I will not tell you who I vote for. I will not tell you why I vote because of the division it creates. I want to just go off on politics, Really, really want to go off on that, guys, but it's just I understand the devastation that does to people and the unity it breaks. And the reality, in my opinion, is we really can't trust anyone. You know, it's like real quick. Let me just go back and let me go back into politics. Here's how I look at politics, you guys. I look at politics like fake wrestling. Okay, so Democrats, Republicans, Undertaker, Hulk Hogan. Okay, when the camera's rolling, it's all fighting, fighting, blah blah blah. But when the cameras turn off, these guys are best friends. We can't trust any of them. We can only trust ourselves. Sorry. But for me, who's the worst of two evils? I didn't mean to go on that rant, but I'm not. Anyways, sorry, guys. I didn't mean to go on there. But look at this. Okay. This is what happened. So I'm like, what the heck happened to the teeth on the Dodd-Frank Wall Street Reform Act? If maybe you guys didn't realize this, but back in 2018, they rolled back part of the Dodd-Frank Wall Street Reform Act. Did you guys know that? Did y'all know that? Let me know. Respond below. Let me know if you guys knew that. I see you guys getting a little political. Don't be getting political too much on the live comments, you guys, please. I just don't want to see you guys fight. We're way more than, two liars representing us, okay? We're way more than that as human beings. We're way more than that. I hope you guys understand that. But I'm going to tell you guys what happened. So again, 2018, the Senate bipartisan Dodd-Frank rollback bill. All right. I didn't know that. I didn't know they rolled back some of the teeth on the Dodd-Frank Wall Street Reform and Consumer Protection Act. This is really, but I'm going to show you guys what exactly they did. Okay. So here's House and Provisions. Here's a few of the things right here. And this right here is one of the reasons for the collapse of Silicon Valley. So there's two primary, and well, not only, what signature, as well as, let's take a look at First Republic is down still, 61%. The 10-year is, let's see, down, oh my gosh, look at this, you guys, geez. Just since we've been talking, it went down, what, another 5 basis points? The 10-year right now is down almost 15 basis points. This is going to result in mortgage rates probably dropping 15 basis points. Mortgage rates today are going to drop probably 3/8 of a percentage. Probably not quite half, less than half, more than a quarter. We don't want this. This is dangerously low to where we don't want it. 15 basis points, guys. Wow. Anyways, so a couple reasons why this situation happened. Again, the first reason is the quantitative tightening. People ran out of money. They needed to get money from the bank. The bank didn't have the money, blah, blah, blah. So one reason, quantitative tightening, and it's a crappy bank, right? But some of the other reasons is the rollback that we're about to read right now. So this is really, really crazy. This bill raises the Dodd-Frank Wall Street Reform and Consumer Protection Act threshold for enhancing regulatory standards from $50 billion to $250 billion, meaning 25 of the 38 largest banks, largest banks in the United States would no longer be subject to stronger capital and liquidity rules. Dang. When I saw that, I'm like, dang, man. When, they passed this right before the lockdowns. I mean, do y'all know that? Do y'all know they did that? Why are we even passing laws if they're just gonna reverse it and roll it back? This is sad. I hope we do a better job at electing people. I don't care what side of that coin you're on, Republican, Democrat, I don't care, but just good people. I don't even know if they exist anymore, you guys, as far as politicians. I mean, this is friggin' crazy, but let's keep going. These 25 banks, collectively hold 3.5 trillion in assets, or roughly 1/6 of the assets in the entire banking sector. These banks took 47 billion in troubled asset. Remember TARP, right? So they took 47 billion, even though we know that they took a total of 236 billion. That's okay. 47 billion in the bailout funds during the 2007-2008 financial crisis. Even more stunning, the bill is not just about regional banks. The 25 banks delegated include the U.S. holding companies of massive scandal-plagued foreign banks. Oh my gosh, I didn't even think of this. Such as Deutsche Bank, BNP, UBS, and Credit Suisse, the last banks on earth that should be deregulated. Oh my gosh. So I didn't know that until I read this article. Do y'all see what I'm saying? Global meltdown here. I mean, this could be definitely a global meltdown across the world. This is insane. The bill also lowers, and this is really another problem right here, you guys. This is a huge problem. This is really crazy. The bill also lowers the loss absorbing capital cushions at 2 of the 8 most systematically important banks in the United States, State Street Corp and the Bank of New York, which play a systematic role in the plumbing of the financial sector, holding combined 60 trillion in assets under custody and administration. Lower capital cushions make these banks less resilient and more vulnerable to financial shock. So again, I hope you guys understand what's going on here. They lowered the capital cushions and requirements. So they basically made it to where they can't, there is no resilience. So anyways, you guys, I hope I'm breaking this down. Let me know I'm breaking this down for you guys. Okay. The right way. I just want to make sure this is a little bit complicated. This is a kind of an evolving situation, you guys. I want to make sure that you guys can understand what's going on. And again, more than likely, we're going to continue to have bank runs. We're going to, and we're already seeing that happen again, you guys, with, First Republic Bank, Signature Bank out of New York as well. I think there's a big event coming. And I think what's going to happen, you guys, is there's going to be a temporary rally. There's going to be a drop of mortgage interest rates. There may be a temporary push back to home buyers buying properties. In return, more than likely that will drop inventory. More than likely that will raise prices. That just depends on how quickly the 25 billion fades away. They've injected 25 billion. So maybe they're going to take that 25 billion and start buying homes, right? You don't know. We don't know. But that's a lot of money. And I want to read this to you guys. And basically, I'm going to read you guys another article to tell you guys how they're selling this bailout to the public, and so that we can better understand it. And I'll take some questions, you guys, as well. But I really hope you guys are understanding a lot of what I'm saying here. So let's see here. All right, guys. So I'm going to read briefly this article. This goes into why this is not 2008, okay? Is Silicon Valley Bank getting a government bailout? Not in the 2008 sense. Federal officials insisted their emergency measures to shore up deposits wouldn't come at taxpayers' expenses, but the public could still bear some indirect cost, one expert warned. And one of the costs is the prolonged battle to inflation. That's a huge cost. For me, it's a huge cost. It means I probably have to rent more, and I am going to rent more. I'm not going to buy right now, just so you guys know that. I want to buy right now because I hate renting, and I don't like where I'm renting. But I am going to continue to rent, and I'm going to probably debank some of my money by putting it in either, treasuries. And well, let me tell you guys just real quick, okay? So, before I continue too much, let me explain to you guys what I'm going to do. This to me is scary. I don't think that the government has enough money to bail out every single bank. And, I think it's unlikely that like Chase and B of A fail. I think that's unlikely, but I definitely think it's possible. And I think if it happens, it's going to happen overnight, and it's going to be shocking to so many people. And now that I'm really thinking about, like, I'm giving my money to a bank that is taking my money, investing it, and making more money, and they can lose all of my money. I'm like, why would I even keep my money in the bank? They're just using my money and losing it, and then just taking the rest of my money if there's a bank run. So, wow. So what I'm going to do is this, you guys. I'm going to try to debank a little, as much as I can. I'm going to be buying some treasuries, right? Because they're 3 times more profitable than the ones that these banks purchased. So I'm going to be buying treasuries. And possibly also because people are like, well, what if the government goes broke? And I'll be like, it's already broke. So how are we going to? That's the other thing. Okay, if the taxpayers aren't paying for this bailout and the government's broke, who's paying for the bailout? The government's broke. Who's paying for the bailout? But this is what I'm doing again. The treasuries, guys, and I may go. I don't know how I feel about it, but maybe some metals. Maybe some silvers. Not a lot. Maybe some golds. So that I become the bank. I just don't believe in crypto yet, and that's what I'm going to do, you guys, because it's just not. Although I think it's unlikely that like Chase fails. it's still possible, and I don't think we're going to get ample warning, and I'm just not willing to take the risk. So in my eyes, it makes more sense for me to take it out of the bank, which we can see it's at risk, and put it into something like a treasury that makes me money. That's historically not risky at all, unless the government goes bankrupt, right? Which is very, very unlikely. Which is why I say also silver and gold. If the treasuries don't work, you have your silver and gold to fall back on. If there's a centralized digital currency, at least we also have gold, right? So this is very hard for me because my niche is real estate. I'm really good at mortgages. I understand lending very well. I understand, the whole negotiation that what consumers go through. I understand a lot about real estate. So this situation, guys, has really forced me to take a step back and to really think on what is the best thing that I can do for my family. And I think I'm doing it. At first, again, this is like a slap in the face. All right. This is like a slap in the face. But remember this, it's also shocking because it's also a sign of the system falling apart. We're seeing systematic failure. We're seeing black swans, and the Fed is trying to stuff that black swan back into the box. The only thing is we saw its head. Okay. So don't be blind. That's my point. Don't forget what happened here. Don't forget what you guys just saw. The 25 billion is a Band-Aid. There's much bigger fish to fry because the biggest lenders, top lenders, did the same thing. Similar, maybe not as reckless. All right. Chase, BofA, right? Wells Fargo, maybe not as reckless as Silicon, but they did the same thing. The treasuries, commercial mortgage-backed securities, they did the same thing. So, you guys, this is going to continue to go down in a bad way. Let me get back to this article, okay? I really appreciate you guys. Bank of China, holy smokes. Earth Minerals, they're saying, excuse me, Cindy, almost got choked up because I read Cindy's comment. So Cindy's thinking we should put our money in toilet paper. Well, the good thing is you can use it as well. So it is an asset, right? Get it? It's an asset. You guys get it? Anyways, it's too early for that. I get it. If this happens, game over. If this happens, you guys, if we're in another lockdown, I was wrong about everything. I mean, I didn't see another lockdown coming. Global depression. I don't think we can handle another lockdown. In fact, I'm pretty sure we can't. Okay, here's BofA. BofA, a lot of exposure too, and they are a much bigger bank. That's what I'm trying to tell you guys. Like, why are we wasting money on the rich when a lot of people are a lot of the little people are hurting? This is a hard one, man. And you guys know, please listen to me. I'm not a financial advisor. I tell you guys that all the time. I'm not a financial advisor. I'm a normal person. I am, licensed in certain things in real estate, but I'm not a financial advisor. I'm just taking you guys through what I'm doing in my own life because you guys know I'm on the sideline. I'm renting as well, right? And I'm going to continue to rent. And real quick, let me just get back to this, and I'll get back to the article. I promise you guys. So this is hard for me. So that's what I'm going to be doing with my assets, right? Maybe some silver, maybe some gold, some treasuries. I'm going to try to debank a lot of the money. I'm still going to have money in the bank. But as far as my home buying journey, now I told you guys I had a few options. I had 3 options I can buy right now. And I'm looking every day. But I am not going to buy something. And neither should you. I'm not going to buy something unless it's a deal of my dreams. It's a great deal. And it's something I love because I know better. I'm not going to buy unless great deal something I love. That's option number 1. I can't find it. I'm looking every day. Option 2, I move back into my rental. Man, that's the easiest thing for me to do, you guys. If I move back into my rental, easy street. My mortgage is low. I don't have to stress about a tenant. I can just lay low, enjoy my life, keep my head down, work, wait for the collapse, right? That was option number 2. I'm not going to do that. I'm not going to do that because I worked really hard for that asset. I can go down on rent. It's on the market right now to be rented out. We've had some people look at it, but I know I have health issues and things like that. And people are like, no, you got health issues. You shouldn't be stressing. Just move back in. I'm not going to do it because, that's not why that exists. It's there. It's great. I'm blessed, but I'm not going to move back into my rental unless I can't find a tenant. If I can't find a tenant, and we're under market value for rent, by the way, significantly. We're like the lowest. So we're getting a lot of hits on it already, but I'm not going to move back in, and I'm not going to take steps backward. I'm going to remain strong, minimize my risks, and just save as much money as possible, like Silicon Valley Bank and all of their depositors should have done. But they got bailed out. I'm not. So I'm going to extend my lease, and probably what I'll do, and my lease is up in June. This hurts me so bad, you guys, but this is just what I'm saying, and this is just what I'm doing. And I want to be transparent to you guys. I'm either going to renew my lease here at this house that I do not want to live in anymore, or I'm just going to take the hit and find another rental that fits our lifestyle a lot better. And I'm going to extend my lease. And the thing is, guys, I'm putting my money where my mouth is. I'm going to take you guys through that. I hate it. It hurts me to say that because I wanted to be moving on with my life, right? And that's put on hold for a little bit. And I think that if people don't understand and look at the situation the right way, or at least prepare to be cautious and understand what's going on, I think that a lot of people are going to get swept up in the next rally. I think that the market rallies today, you guys. It's going to open in a couple hours. I think the market rallies today, and I think what's going to happen is CPI is going to come out tomorrow, Tuesday, right, the 14th. CPI is going to come out tomorrow hot. We all know that, right, by now. I'm almost positive CPI is going to come out hot, which would generally drop the market. But my fear is, I fear that the market's not going to care about that CPI because they just got 25 billion. Who cares about the CPI if they can just continue to do toxic lending and get bailed out? Who cares about CPI? Who cares about that battle? They're still going to fight the Fed. And why wouldn't they? Right? The Fed has proved that they're weak, that you can't count on them. So milk them, milk the money for as long as you can before we're under a total collapse. So I think that the market's going to rally until it just collapses and breaks. And I think the CPI is going to come in Tuesday. It's going to come in hot. The market's not going to care. Then on the 22nd, the Federal Reserve meets. We were hoping for 50 basis point increase. We all want 50 basis point increase. I think we need a 50 basis point increase. I don't think they're going to do the 50 basis point increase. I don't think they're going to do it. I think they're going to take the easy way out. I think they're going to kick the can down the road. And I think that's going to crush us even more, to be honest with you. But only time will tell. That's just what I'm thinking. Let me get back to this, you guys. I'm super sorry. All right. I like this. I like this. Okay. Wealth energy. I like it. Okay. I like it. Seeing some of you guys' comments. Okay. Very nice. Very nice. Whoops. Okay. So let's read about what happened, okay, and what they're selling in the public. Absolutely shocking stuff here, you guys. Washington officials have announced they are guaranteeing all the deposits at Silicon Valley Bank, which, remember, they're only supposed to insure 8%, and the average deposit was 1.1 million. 92% of the money in that bank was not supposed to have been insured. And I did not give them permission, neither did you, to use our taxpayer money to bail them out. Basically us suffering and paying the bill once again. All right. So in a joint statement Sunday, the U.S. Treasury, the Federal Reserve, and the Federal Deposit Insurance Corporation said the extraordinary measures they were taking to shore up SVB deposits would not come at taxpayers' expense. Whose money is it? Whose money are they printing? The government's broke. Asked whether the action constituted a bailout, a senior Treasury official emphasized the point Sunday night. Okay, so they're saying this isn't a bailout. The taxpayers aren't going to pay it. The FDIC is going to pay it through the asset sales, but we need the money printed in order to give that money to FDIC to refund the depositors. That money is being printed and coming at a cost. If it's not coming from the taxpayers, we're certainly going to pay it through inflation and through home values and for the continued asset bubble. We're paying for this one way or the other. Anyways, instead of cost of covering the deposits, including uninsured amounts in excess of the FDIC's $250,000 limit, will be paid for in part out of the agency's deposit insurance fund, a reserve that is paid for by quarterly fees on banks. Okay, so they're still going to be paying some of that, according to them, from the agency's deposit insurance fund, you guys, which is cool. But again, I'm going back to the 25 billion and the fact that that's not just going to help them out; that's going to help numerous banks out, unfortunately. So it's not isolated, you guys. That's the thing that I'm so sad because it's going to allow multiple banks to recover from those toxic assets. Maybe it's commercial mortgage-backed securities, maybe bonds, maybe treasuries, but it's going to allow multiple banks to reset. That's not fair. And actually, not only is that not fair, it goes against everything that the Federal Reserve has been telling us that they're going to do to fight inflation. Let me be clear that during the financial crisis, there were investors and owners of systematic large banks that were bailed out. And the reforms that have been put in place means that we're not going to do that again. You guys hear what they're saying? So they're not going to do it again, but yet they're doing it again. I just showed you guys. 2008, they purchased toxic assets from the bank. The banks paid that back. 2023, the banks are going to get bailed out. The federal government is printing out money to purchase toxic assets, securities, treasuries, bonds. And the way they're selling that, again, the FDIC is going to pay that money back through asset sales and their own funds. This is crazy, okay? Funding for the emergency measures will also come from selling off SVB's assets, said Morgan Ricks, a banking professor at Vanderbilt Law School. As a result, he said taxpayer dollars will not be directly implicated because of the backstop measure. So we can also assume from that statement that they will be indirectly affected. This is what it is. This is what they're selling us. This is the key difference from the congressional approved bailout of the U.S. financial system authorities approved in the fall of 2008. That legislation, called the Emergency Economic Stabilization Act, embarked $700 billion to create the Troubled Asset Release Program to purchase toxic assets from banks. That is false. All right. The reason they're saying that is $700 billion looks like a bigger number. So that means that 25 billion doesn't look as large, but we just read the information that said it was not. 700 billion was the total that went to many places, car industry, GM. It was 236 billion, not 700 billion. Do y'all see what I'm saying? Y'all see the nonsense here? But they're not wrong. TARP was allocated 700 billion, but for the lending institutions, 236. Okay. By designating their backstop measures as a systematic risk exception event, Washington regulators sidestepped a vote that would otherwise be required from Congress on whether to backstop the bank's depositors. So they sidestepped it. And this doesn't, what is the key? So the key difference here, so it was talking about the key difference. The key difference is one was approved by Congress and the other one was not. That's the key difference here. And that's basically what this is saying, right? Let's keep going. The exception designation required the approval of 2/3 of the Federal Reserve Board of Governors, 2/3 of the board of the FDIC, and the Treasury Department in consultation with the president, Rick said. The agency's joint statement Sunday said any losses to deposit insurance fund ultimately incurs to support depositors will be recovered by ongoing fees of banks. And the depositors are the rich. Just want to make that clear. They're saying we're going to help the depositors. We're going to help the normal people. They're not normal people. These are filthy rich people. They're not normal people. This is so frustrating. Assuming there are losses, Rick said, the cost of the guarantee of all depositors will be borne by banking customers. In other words, the wider public. In such a scenario, he said, part of it should be expected to fall on bank customers indirectly. All right. Do y'all see the problem here? Anyways, here's another thing I want to point out. All right. And I got some blowback from this. And I said, basically, FDIC don't have enough money. FDIC is insuring, I think, is it $5 or $6 trillion? I think the FDIC is insuring $5 trillion. And look at this, they only have 128 billion. That's less than 2%. So FDIC is made to calm the public down. They cannot insure all of our money, right? Do y'all see the problem with the banking system? And that hurts me to say. It really hurts me to say that because I want to have faith, I want to have peace, but I'm just from what I'm seeing here. I'm just reporting what I'm seeing. This is bad. The deposit insurance fund balance was 128 billion as of December 31st, according to its filing. 89% of SVB's 175 billion deposits, or about 156 billion, were uninsured. Okay, what does that mean? Let me explain. Okay, this one bank, all right, $156 billion was uninsured. So that means this number 15 bank, real, kind of low in the totem pole, if they didn't have the assets, additional assets the FDIC could sell to help pay this, the FDIC is done. This one bank run, if they didn't have the assets, and I know they have the assets, but if they didn't have the assets, and they actually don't have a lot of assets, so I don't know, they don't have all the assets. This one bank run would have caused FDIC to fail. Do y'all understand what I'm saying about the FDIC? The FDIC, maybe it worked in the past, but right now it's like the banks are so greedy, it's just not working. They're just so recklessly, lending and recklessly spending. The FDIC don't work. The FDIC is to make us feel better. Okay. Here we go. Here's my man right here. Take Larry. First of all, Larry, appreciate you, man. And I'm going to get back to this article. Larry, definitely appreciate your support on the channel. You guys don't have to do that, but it does mean a lot to me. So thank you, my friend. This is the equivalent of taking $100,000 insurance policy on your house, lighting it on fire, and having them pay you $1 million for it. And that's why I'm freaking... Thank you, Larry. It reassures me that I'm not crazy here. Like, thank you for reassuring me. I completely agree with Larry here, you guys. He's right. And that's why I'm saying, you guys, that's why this is so heartbreaking, because it's just the rich getting richer at our expense, and they're lying to us right in front of our faces. They're not even hiding it anymore. What has happened to our nation? Also, I really appreciate you, Conjure, appreciate that $2, man. It means a lot to me, you guys, supporting my efforts here. I'm afraid I'm going to lose my job, quite frankly. So luckily I have other income sources, but I just don't know how I'm going to be able to keep my job, you guys, to be honest with you. I'm in, training and marketing. That's one of the first things to go in the real estate industry. So back to this. Okay. Rick said there is no way to know yet how much the federal backstop measure will ultimately cost, adding that it will depend in part how much regulators can recover from selling the bank's assets. So they don't even know. They don't even know how much they can sell. Okay. It's entirely possible it will cost zero. Come on. It's already cost us. Look what it's cost us. They're selling assets. I think this is the result of, again, like I'm saying, it's either the market is fighting the Fed and they're not buying treasuries or putting money back to the stock market, and or this is them selling the treasuries from Silicon Valley. I think that's what this is. I think it's them selling the treasuries. Let me know what you guys think, what's going on here with the 10-year. In a perfect world, we would see the 10-year go up because they just saved the bank. So now let's keep them up, keep the rates up, right? Let's continue our battle. But the opposite has happened. So it's already cost us. You guys. This is going to hurt us right here in the near term. Okay. Todd Sachs just texted me. I'm doing a live. Let me see if Todd wants to do a live with us. I'm doing a live. Let me see if Todd, you guys know Todd Sachs. I'm going to ask him if he wants to join us real quick. He said, call me, it's important. Dang it, Todd. I love Todd, you guys. I actually went on and did a live with him right out of my procedure, my medical procedure, because he's my friend. He needs my help. So I'm going to ask Todd if he wants to join. It would be really cool to get Todd's thoughts on this as well. But to ensure it could be zero, meaning it's entirely possible to recover, blah, 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 blah. So I don't know, you guys. This is a pretty crazy situation. Let me check the stock market. Jeez, look at this. Here is First Republic Bank right here. Oh, Todd can't do it. Down 64%. So let me know if you guys think that First Republic Bank is the okay, he's to call him later. First Republic Bank is the next one to go. It certainly appears that way because they're asking for help. So I'm thinking it's going to be counting Silvergate. Fine, we'll count Silvergate. This is going to be the fourth bank. First Republic Bank is going to be the fourth bank, in my opinion, that will have a bank run and that will need money from the $25 billion. I can almost guarantee that. And honestly, that's what the market thinks as well. I mean, 65% down pre-market, substantial. Again, here's the 10-year. If anyone else is just logging in right here, I mean, this is crazy. Right, I know. Yes, Signature Bank was seized. Yes. I thought I brought that up for you guys. Let me see if I could show you. I thought I showed you. Yeah, right here. See? Boom. Then this happened yesterday. Signature Bank is closed by regulators, the third U.S. bank failure in a week. And we're about to have the fourth one today. I believe it's going to be the fourth one today. Again, First Republic Bank is showing us this is going to be the fourth one today. Buyback plan. I mean, the futures market is probably banging right now. Let me see if I can show you guys real quick. Interesting. Let me look at Tesla real quick. See what's going on with Tesla, which is the market, right? Tesla is really the stock market, in my opinion. Wow, that's surprising. Tesla is down pre-market. It was actually started up pre-market. It's now down. Pre-markets went up a little bit. This is interesting. So it is possible, you guys, that things are a lot more worse than what we thought. And it is possible that the interest rates going down like this, specifically the 10-year going down like this, isn't. Oh my gosh, look at this. Oh my gosh, you guys. Holy smokes, look at this. Dang. This is insane. The 10-year is down now. Well, it was down 20 basis points. This is crazy, man. So the 10-year treasury is down. So it is possible, like I'm saying, you guys, that things are so messed up that this is the pivot, right? But the thing is we have seen effects in the housing market, but not to where the effects in the housing market is not to where it's affordable yet. So it's like the work isn't done in the housing market, the super sticky inflation sector, right? And it will be. But my God, you guys, this is dangerous. Rates are going to go down 0.5 point today. Mortgage rates will go down 0.5 point today. Mark my words. Not maybe even more. To be honest, they may go down. Looking at this, 0.5% today, which is not what we want. We want people not to buy. We want inflation to go down. So, here, okay. Let me take some of your guys' questions, if I may. Okay, let me go here. Camera 2. Okay. Sorry, guys. I got ready at 5 o'clock in the morning because I couldn't sleep and I have a lot of work to do. So let me kind of take some of your guys' comments here. It's possible, Kim. It's possible. I just don't buy it. I don't buy it. I just don't buy it. I don't buy it. I think they need to keep raising interest rates. In fact, I think they should raise interest rates even more. But I've been thinking that the whole time because we need to get through the pain. The flip-flopping and the whiplash and the tiptoeing through the inflation battle is only making the problem worse. We need to stop it now. And that's why I'm afraid of the of digital currency, centralized banking digital currency. I'm afraid of the central digital currency, you guys, because they can't control things. The Federal Reserve cannot control spending right now. So, Kim, I think it's possible, but I don't think that's likely. I think they may just do a quarter. I don't know, though, but okay, here's Cindy. Dow futures are down now. Yep, they are down now. Pretty crazy. Let me just go back to the futures and see where we're at real quick. Yeah, the Dow is down. S&P's up. NASDAQ's up. Obviously, gold's up. And silver, you guys. Gold and silver is up. I don't know, we may have to get some gold and silver. So and we got another buy toilet paper. You guys, where should we put our money? Okay, this is a good question. Why is it a big deal that the 10-year is down? Because the 10-year basically affects mortgage rates. For one thing, right? For one, that's one of the reasons that it's important. And just sticking to that one thing, the higher the 10-year goes up, the higher mortgage rates will go. The lower the 10-year goes down, the lower the mortgage rates will go. The reason why it's important for mortgage rates to stay high and the 10-year to stay high is so people stop spending, so that the market properly resets. If people continue to spend and do not let the inventory come back, we're just going to be in the same situation. If we're going to be in a worse situation than we were before we started quantitative tightening. People need to stop. People really need to stop. What's up, Wolf? I love Wolf. Wolf is one of my subscribers that actually drove to the area of Phoenix and checked out where I said, you guys, I found where the epicenter of the housing market crash is going to begin. And my man Wolf drove out there and he's like, yep, he was right. Because I got a lot of hate. And the area that it was in is in Phoenix, Desert Oasis, Copper Canyon. Mark my words. I know, man, hyperinflation. And that will lead, hyperinflation, stagflation. It's not going to keep up with wage growth, depression, deep recession or depression. And it probably is going to be a global thing. It's probably going to be a global thing. Centralized digital currency. That's how that comes in. Or at least that's how I can see centralized digital currency taking over. No more dollar. No more dollar. This is how that happens. If this keeps up, if this kind of crap keeps up. All right, let's see, you guys. Throw up some stuff. I'm going to go to the bottom real quick. Okay. I'm not a financial advisor, right? I'm not a financial advisor, and I don't want to lead people. So I get really scared because I don't want to lead people down the wrong path, because what I'm saying is it's actually really important to me. But all I'm saying is what I'm doing, Christine, with my money, and that is I'm debanking as much as possible. I'm going to put most of my liquidity in treasuries, probably get a 3% profit, 4% profit. Maybe I'll do a 6 month, maybe I'll do a 1 year. And then tangible assets, possibly gold, possibly silver. I don't know. You may want to do the same thing. You may not want to do the same thing, but that's what I'm doing. You guys, let me scroll to the bottom here and take some more stuff here. I think you're right, Roberto, because again, remember what I'm saying, you guys, the federal, oh my gosh, you guys, this is freaking crazy. I got to show you guys this in a second. My God, the 10-year treasury is dropping off a cliff right now. So this is why, even if, and to go to Roberto's point here, even if we have a 50 basis point increase on the 22nd of this month, that's not going to matter if the 10-year keeps going down like this, because it's not the federal funds rate that's affecting mortgage rates, right? It's the 10-year treasury. And that's why the 50 basis points, it may not even matter. Take a look, you guys. Look at the 10-year right now. We're in the 3.4s. We're in the 3.4s right now in that 10-year. This is a shocking turn of events. 21 basis point drop. Again, mortgage rates will be at least a half a point lower today. So you guys, if you are in the process of purchasing, my advice would be probably to lock your rate. Probably going to be a good time to lock your rate. All right, let me see, you guys. We've been doing this for about an hour and 18 minutes. I hope you guys are learning. I hope a lot of this made sense to you. Farmland, iBuyins, okay. So this is another concern, you guys. They're saying the treasury market will finally collapse. That's possible. A lot of people are afraid to buy treasuries right now. Here's the thing, MB. We've already seen that. They're already doing 40 years with loan modification. I would say that we can't do 40 years because of the Dodd-Frank Wall Street Reform and Consumer Protection Act. But what did we learn about Dodd-Frank today? We learned that they can easily roll back measures through Dodd-Frank. It is what it is. Now, if that happens again, they're just passing the buck, you guys. Obviously, we need the price to go down, not the payment necessarily. Another 40-year. Yeah, credit card debt is horrible, you guys. Absolutely horrible. You know, Original Sauce thinks this is a planned collapse. I mean, COVID, lab leak, China, right? Scary to think about. It appears planned. Huh, that's funny. I like it. If you don't own it, right? Good old days, if you don't own it, you shouldn't have it. It's not like that anymore. Okay. Now, here's what Roberto's saying, and I agree. The 10-year will come back up as soon as the market prices in the hike, and with the drop, markets will shoot up. Fed will hike more. So here's the thing. This is what I hope is going to happen. All right. I hope it's going to happen, but I'm tired of hoping for things and getting my feelings hurt, if you guys know what I mean. So I'm going to hope that this happens, but I think that's possible. I think that, initially here that 10-year is going to plummet. We already see it plummet. The market is going to rally. In a perfect world, it's going to be short-lived. I don't know how short-lived, but I do not think it's real. Again, CPI comes out Tuesday. Fed rate hike on the 22nd of this month. These are all signs, CPI, market rally. These are all signs that we need additional rate hikes. Even a child could understand this. So they should raise rates 50 basis points on the 22nd. Again, I just don't think they are. CPI is going to come in hot. And eventually, I believe the 10-year will come back up, and I believe the stock market will crash. I think this is all fake. I think it is a temporary thing. So well said, Roberto. I definitely agree with that. I would say, probably the CEOs that cashed out at Silicon Valley for one, and the people behind the scenes, and really anyone associated with the $25 billion that they're getting now to replace toxic assets. I would say mega rich are getting richer. They no longer have to worry again about the toxic assets. And that's just not Silicon Valley and Signature and Regional Bank. This is multiple banks will have the opportunity now to get rid. Here's the thing. I don't want to say get rid of their assets, but here's what they're doing. In order to get some of that 25 billion, the collateral is the toxic assets. So even though it's not a collateral, that's not really collateral. They're lending these people money from the $25 billion based on the maturity of their assets, the securities, the bonds, based on the maturity value. Anyways, if I could, I don't have really any toxic debt, but if I could trade toxic debt for like super favorable financing, I would do it right now. But I mean, I don't have toxic debt, like credit card debt. Credit card debt is like mob debt. Okay, credit card debt is horrible. Yeah, there's going to be, good point. There's going to need to be a new mortgage because people can't even afford to pay for food. And I just want to tell you guys this. Even though we're seeing the rich just got bailed out. I said to you guys, the rich is going to lead this crash, right? I said many things. There are many reasons why, and I've stayed to this point. But the rich got bailed out over the weekend. So what's really astonishing to me is how many of the lower class are hurting right now, and we haven't even have the inflation really combated. Banks are falling apart, bank runs, but what people are not talking about that much is the amount of people that are suffering right now. The lower class is suffering right now. They're drowning in credit card debt right now to survive. Do y'all really think that we can afford not to fight inflation? We got to remember all of the people that are suffering, all of the people with nothing right now, right? And I'm not talking about necessarily like the poor. A lot of like the poor. There's government programs that are propping them up. But I'm talking about like the middle class poor is dead. They're stuck. The middle class poor that can't qualify for programs and that can't get ahead in life. Think of all those people, you guys. As you and I are waiting for the housing market to reset, think of all the people that are suffering right now. As the rich get bailed out, as the rich become richer, think of all the people that are not getting help. So how is it fair? How is this fair? The people that are making high risks, they knew they were making high risks. It's commercial lending. It's not to survive. How is this fair? It's not fair. It is not fair. Okay, so let's keep going here. released on purpose. I think they're talking about COVID. And I want to talk about what Jeremy is saying here. This is similar to what happened last time, you guys. After, what is it? October of 2008, things got really bad. So October 2008, that's when TARP was passed, 700 billion. And then things got really, really bad. And that's what I'm saying. We may not understand how, like, we know things are worse than we think, but things may be so worse than what we think that the Fed has decided to pivot. I just don't buy it. I think it's still too soon to pivot. I think if they do pivot too soon, it will lead to a global depression. But although Jeremy, I'm frustrated because it's not fair. It's a typical nonsense. The bailouts of these guys, although it's not fair. Also, I am also reassured that this is going to be a mega collapse. Because, a little bit of me I was worried that it was like that, that shock flash, which historical property decline, by the way, historical on average, historical. I was like, I wonder, if it's going to be I thought it may be a slow bleed out from there, right? And especially because of markets like I look at the St. Louis market, Florida, but I think it's going to be worse now. I think these are signs that are showing us this is not going to be a soft landing. This is impossible to become a soft landing. I think that, because I need more time to process this, but I think this is what the pain is looking like. I think that we're starting to see the pain and we're starting to see the true intentions of the Fed, because actions speak louder than words. Actions speak louder than words. So I think we're starting to see the pain, and we're going to start to see a Fed that's useless. I think that's what we're going to see, you guys. And I didn't want that. I wanted a mild crash, mild recession, because I remember and I felt how bad 2008 was. And again, in order for us to win, a lot of lower class people have to get hurt. And we really, I think when we're human beings, you guys, and we take a step back, we really don't want people to get hurt. So I'm not like, yeah, let's hurt people. It's just like, I'm looking at the business aspect, the economic aspect of this. It's like, this doesn't work. All these other people need to be helped. It's just a messed up situation. But we didn't do this, though, guys. I just want you to know that it wasn't our fault. It was the Federal Reserve, right? The quantitative easing. So a lot of people are like, should we just, all this collapse, gold collapse, treasury collapse? And I was actually talking to Jeff. I always talk to Jeff. And he's like, should we put our money in real estate, right? Should we just put our money in real estate because it's an asset hedge, right? It's an asset hedge. But you have to remember, you guys, this isn't 2008. Like, now I'm the one saying it's not 2008. What happened to all the other haters saying this is not 2008, but it's not 2008? Let me show you why. All right. Let me show you why. Boom. Okay. Here's why. Let me take this comment off of here. Okay. In 2008, this era right here. Okay. We could go up still a little bit in home value, although we didn't. But right now, you guys, we can't. Homes aren't an asset. We melt them. That's the run up in equity. Excuse me, in about 2.5 years. Look at how it's comparison to the first bubble. We can't go up any higher on home values because we have maxed out and broken fundamentals. We've maxed out the values of houses. We've broken fundamentals, and that's why I'm saying I think it's a trap. It feels like we should invest in real estate right now because it appears that everything else is falling apart. But I'm trying to explain to you guys, we've already wrecked real estate. It's already wrecked. It's already overvalued, and it in my opinion, would be a mistake. I hope so. Look at Mike. I like Mike's passion. Okay. I'm looking at the stock market real quick, you guys. All right, S&P is down. This is good. All right, I think this may be a good thing, you guys. So maybe the market is, let me show you guys. All right, look at, when I first started watching the market, everything was up. Dow, S&P, NASDAQ, all the futures were up. It's changing, okay? This is good. I think it's changing because of this. Because to me, This is telling us there's a problem. There's a massive problem here with the asset bubble and the banking sector. So maybe that's what it's telling us. Maybe people are like, you know what? Maybe we shouldn't rally because maybe things are really much worse than they actually appear to be. And maybe that's what we're seeing here. We can only hope. I don't know for sure if that's what we're seeing, but I can tell you now the futures are down. It was not like that. 10 years still down 20 basis points. Okay. Pretty insane, you guys. Pretty insane. Let me go back here. Let me take some questions here. Let me go back to right here. All right. I mean, Roberto's right. I mean, we just saw the black. I just want you guys not to forget the black swan that we saw. We just saw a black swan peek its head, and we saw the Federal Reserve try to stuff that black swan back into the box, which means we can't trust the Federal Reserve to tell us the hard truth. Don't forget that. Just like in 2008, we couldn't rely on Ben Bernanke to properly warn us so that we can do what was necessary to protect us. That's what we saw. All right. Don't forget that, you guys. Hope not. Bury it, right? Or don't buy gold and silver. Okay, here's Cindy. I fed the fear of missing out factory for all regional banks. They're all be lining up with their hands out. Of course. And the thing is, Cindy, and you guys, why wouldn't banks want a handout? That's what banks love. And that's why this whole thing is so frustrating. And again, because it goes beyond Silicon Valley. This is beyond Silicon Valley and Signature. They're opening up the discount window or the ability to borrow against toxic assets, the ability to borrow against toxic assets being the collateral to multiple banks, not just these banks here. So they're allowing some of these banks to reset at our expense. This is crazy. I love it. Love it. So please stop worrying the kids. I don't know, man. Michael, I think that people should be worried because if they're not, it usually means maybe not you, right? Maybe you're smart and have everything figured out. But I actually think that worrying and fear can be a good thing. And strong people use that as motivation. And, I would replace that worry with awareness because we didn't make this happen. This is happening right now. So you could choose what to do with it, Michael. But I'm not going to stop talking about it. And I think that people should worry right now because if you don't worry, you're just going to be caught up in the wind. How do I know that? It happened to me last time. I kept my head in the sand in 09. I'm like, let's just go, man. Let's not worry. Don't worry the kids. Who cares, right? This has never happened before. And I woke up and I lost everything. So by all means, don't worry if you don't want to. I don't want to force people to worry. Appreciate you, the employees of the rich. Okay, yeah. Okay, and that was another thing, you guys. So they said they did all of this so that they can make payroll. All right. But yet the Fed said we're going to battle the labor market, unemployment. This is just so crazy, you guys. Let me go here. So again, Michael's saying gold and silver. Okay. I'm not. No. I'm not middle class, man. I'd say I'm lower class as well. I'm not a rich person, you guys. Not at all. 4% inflation could be the norm. It's also possible. Banks consider business debt and lending safer than individuals. Not this time. It surprises me because not this time. We're seeing a collapse in commercial versus residential this time around, which is crazy. And again, this leading catalyst, I'm saying prices, new home building, but also I said another one that is like right behind that, commercial mortgage-backed securities, commercial sector. We can argue that that's what happened as a result. That commercial fracturing led to the bank run, right? The commercial fracturing, meaning these businesses needed liquidity because they ran out of money because of quantitative tightening. They went to the bank to get their money. Money wasn't there. Bank run. Virus. I mean, there's just some people I talk to are like, all this started happening because the election was stalled, blah, 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 blah. And I'm like, okay, yeah, I get your point. Pretty shady what went on. But I was like, actually, it happened when the virus hit. A lot of people think that was done on purpose. I'm not going to go there. Then you're at the mercy of the market, Hope. If you have to relocate right now, then you're forced to sell. If you're forced to sell, you're at the mercy of the market. The market right now is dangerous in the sense that homes are overpriced. The 10 years going down again. Homes are overpriced and interest rates are high. The work is not done by the Fed. Okay, let me see. Oh my gosh, yeah. I mean, see, this is a really good point. So, the Ohio toxic spill, the Ohio train derailment, and I apologize for saying spill. They intentionally released the chemicals, not spilling, releasing the chemicals. Bunch of the people there are like, please help us, our children, get us out, help us, we can't afford to leave. They're dying. People are dying, getting cancer, they're getting sick, and the government failed them. Where's the bailout for these people? And I agree, Marilyn, where's the bailout for them? Why is the bailout going for people that are rich, that have jobs, making stupid money? And remember, if you feel pity for the depositors at Silicon, remember the average deposit was 1.1 million. We have people in Ohio that can't even afford to get a U-Haul truck, and we got no money going to them. How is that fair? How are the huge banks getting bailed out, and these good people are not? Just doesn't seem fair to me. Good point, Marilyn. Let's see here. Do I think your money is safe in the banks, Adrian? Well, not if it was if it was in Silicon Valley, it was safe because you just got bailed out. I don't feel like anything is 100% safe. There's just a lot of stuff going on that's really eye-opening. It's no longer like conspiracy theories that's going on here. These are things that are happening right now that, like I said, I'm worried about it. And when I worry about it, I'm aware about it. When I'm aware about it, I can fight. I could do something, I can plan, I could do that. But one thing I'm not going to do is I'm not going to keep my head in the sand. Okay, good. They're confirming the cuts out in the Bay Area, and that's what this live was supposed to be about. I was going to show you guys all of the price cuts that were going on in Silicon Valley, which was at about 20% from peak, by the way. Exactly. This is what I was trying to say, Jordan. It's a really good term. So canary in the coal mine, and that's what we saw. That's what we saw over the weekend, and we saw starting on Thursday. So canary in the coal mine. They had the bank run. FDIC took over 2 banks. Okay. Signature as well as Silicon. So and that's what I'm saying. Although I'm frustrated, I'm frustrated. This is a sign of a bigger event. And it's also a sign that the Fed is useless. So good luck with the soft landing, right? So I'm assuming they're saying that because of money printing. Is that why you're saying that? Is that why you're saying that? Looks like Biden's speech is delayed. Thank you, Sparky. Interesting. Which y'all think? Y'all, and by the way, if you're just logging on now, happy Monday, you guys, and good morning. I hope you have a great week, and thank you for joining me on this. We went through pretty much the entire situation with Silicon Valley, Signature Bank, the 10-year Treasury. We went back and we looked at 2008 laws. We looked at Dodd-Frank Wall Street Reform Act. We asked ourselves, how can they get away with this if the Dodd-Frank Wall Street Reform Act was supposed to eliminate bailouts? There was also deregulation or a pullback in regulation on Dodd-Frank Wall Street Reform Act in 2018. We also went over a list of the last lenders to get bailed out in 2018. We talked about the biggest collapse because Silicon was the second biggest, which the biggest collapse was WAMU, Washington Mutual. I really just so appreciate you guys joining me. You guys have no idea how blessed I am to have you guys on the channel, to have you guys' support. And I know not everyone agrees with me, and I really appreciate that. If there's realtors watching you guys, I'm going to try to do a better job at, like, I don't mean to attack you guys, realtors, unless you're one of the bad ones. And I absolutely do mean to attack you. And I hope you're upset by what I'm saying, because you should be. But, for the good realtors that are actually trying to figure things out and trying to learn, I'll try to do a better job at telling you how you can help people. All right. And that's market analysis. Just FYI. This is a good point. So here's fond treasures. This weekend was not a fond treasure, I'll tell you that. It was to the people at the bank. 40-year mortgages will bump up housing prices, essentially lowering potential monthly payments by 1/3. No, it's not going to lower payments by 1/3, because the 40-year mortgage is. Oh, I see where they're getting that, because it's 1/3 more years added to the amortization schedule, but it will not drop the payment 1/3, because remember, there's also mortgage insurance, there's taxes, there's insurance. But I do agree. The problem with bringing out 40 years, 50 years in IO or interest only loans is it's going to lower the payment, even though it's going to lower the payment, and it's going to keep the pressure on prices going up, right? And that's passing the buck. That's putting a Band-Aid on the bullet hole. We need the big thing handled, which is the prices. And again, do I have to go back? Let me okay, one more time. Okay. Again, here's the prices. Okay. Right here. See this little first circle right there? That's the run up in prices. That's what's breaking fundamentals. That's what we can't have. That's why I'm saying don't buy real estate right now. It's not safe. It's overvalued. We've already milked real estate for all it's worth. Okay. So 40 years, I think, would be a huge mistake. I agree with Ace Ortez. More inflation is definitely inbound. There's no doubt about that. I'm pretty sure we all know that. Again, I agree here. Black Swan peeking head out of the box, got a 2x4 on the head. But it's still in the box, right? That's a good way to put that. But it's still in the box. Future market is remaining sideways, slightly down. Biden to speak at 9 a.m. About weekend actions to stabilize U.S. banking system. So Biden's going to be talking today, you guys, at 9 a.m. about what is happening. He's going to try to talk and give us confidence, but my confidence is lost. I've already withdrawn all of my money out of Fidelity. And like I said, my plan is to debank because I'm not willing to continue to give these banks, my money, my hard-earned money, and have them use that money to get rich. And if they fail, they take my money and get bailed out from the Fed. I'm not going to do it. It just, at least right now, I'm not going to do it, you guys, until more dust settles. I'm debanking as much as I can because this is don't forget the Black Swan event. It is. This is the point. Right? You guys, I think that pretty much I got to show you the 10-year. 10 years dropping so bad right now. I'm going to show you guys the 10-year. All right. Already. So, I don't know why people don't listen to what I'm saying. I'm saying people say that this happened because of the election being stolen. I'm saying that's not true. So there's just a lack of comprehension. There's a lack of people paying attention to what's going on. People hear trigger words, and when people get triggered, their emotion takes over and their logic is bye-bye because of a trigger word, when the reality is people need to calm down, plan, respond, appropriately. Don't just react and throw up emotion. And I see that all the time, you guys. But so I appreciate you guys staying here. Oh, Janet said bye, Felicia. Janet, I love you. Appreciate all your support, Janet. You've been here from the beginning for the most part. Interesting. Okay, this is from Mike. The virus was released right after China signed the tariffs that Trump put in place. That took months to sign it because they didn't want to. Once the virus broke out worldwide, the tariffs were torn. I don't even want to go there, but I'm just so skeptical. I know, Vital. I'm watching that. It's actually lower than that. We're actually down. I'll show you guys right now. We're down a little bit worse on the 10-year. We're actually down 24 basis points right now. This is good. This is going to be a massive drop in mortgage rates today. Massive drop. So, payments are lower. Obviously, more people are going to buy houses. It's going to lead to more inflation. But this is crazy. Massive, massive drop right now, Vital. Massive drop. And again, what I told Vital is Vital is worried. I was like, Vital, I'm in this with you, dude. I'm not going to buy. I'm putting my money where my mouth is. So I don't want to hear your whining because I'm whining. Well, actually, I do want to hear it a little bit because I know you're hearing me whine. But the home prices are milked. The value is milked out. It has been torn apart. Our housing market has been completely broken and wrecked. You buy real estate right now, you're buying homes that break all fundamentals, that are drastically overvalued. To me, that's not where I'm going to put my money. That's not where I'm going to put my money. It's a lot of money. It's not where I'm going to put my money. It's still overvalued. I pulled up a list as well, Vital. But again, the reassurance here is to me, this is a sign of the cracks. This is a sign of bigger things to come. I love you, Vital. Hang in there, brother. I love hearing from you, man. I couldn't sleep, you guys. I was planning on doing a live at 8 o'clock today. I was going to do it, based on these companies not being bailed out. But I was just lying there. I couldn't sleep. I have work to do today, but I couldn't sleep. And I'm like, I just got to go, man. And I wanted to do this before the market opens. Geez, the 10-year is down 25 basis points now. 10-year is down 25 basis points, you guys. Okay. So there's no way banks are going to be rushing to lend right now for overpriced real estate. Here's the thing. I disagree with that. I think that they do want to lend right now on real estate that's overvalued, because they're just going to get bailed out if it doesn't work, number one. But number two, the interest rates are 6 and 7%. Trust me when I tell you the banks want to lend at 6 and 7% interest rates. So, but the thing is the risk, right? So you could be right. You could be right. I just don't think so. I think that they actually do want to lend, but ain't no one want to buy. A lot of people don't want to buy. I'm not doing it. I'm out. I wanted to short builders, you guys. I wanted to short Lennar, but with these bank runs and such, I'm just done. I'm minimizing my risks as much as possible. I pulled out all my money from Fidelity. I have no money. I have no ability right now to invest in the stock market. I have no ability to short Lennar. I am not willing to take the risk, not after everything I have seen and everything that I've been through in the past. I'm out. I'm not investing anymore in risks. I'm out. I'm stepping away from risk. I'm even renting right now. But I think that, oh my gosh, I got to show you guys a 10-year before I go. The 10-year is just crashing. I mean, this is a significant event, you guys. This is a significant event happening right now. This is a systematic failure. This is a black swan. We're seeing a black swan try to be stuffed back in the box. But again, we remember what we saw. Don't forget what we saw. We saw the black swan. We saw it peek its head out. We see the Fed trying to stuff it back in at our expense, and we see them lying to us about how it works, where the money's coming from. This is historic. This is a historic situation going on right now. But they don't. That's why the rich get richer. In fact, the CEOs took money out before the collapse. Listen, the Silicon Valley CEOs took money out right before the collapse. Which means what, you guys? What does that mean? The CEOs took money out before the collapse. It means that they saw it coming and didn't warn us. Why didn't they warn us? Well, maybe they think they couldn't warn us, because if they warned us, they would have taken their money. A bank run would have happened. So call it what you want. We can't trust them. I hope you guys are seeing that. You can't trust them. That's why I'm always telling you guys, you have to empower yourself. You have to educate yourself. You have to become an expert yourself. No one knows your situation like you do. You can't trust anyone but yourself. And if you want to be confident in yourself, you have to continue to educate yourself, right? Buy some legit. Oh my gosh, that's scary to think about. This is just really sad, you guys. I'm really sorry that we have to go through this, but at least I'm going to go through it with you. This is really, really heartbreaking. This is really frustrating. But again, take some of the reassurance. Again, we went through the 2008 situation. Man, the 10-year is just blowing my mind right now. I take this as a situation as bigger things to come. I take this as a situation as we're actually going to crash harder than 2008. They allocated 10% of what they did in 2008 for the bank bailout. 10% without a vote from Congress. 10%, you guys, over the weekend, not even a working day. Why do we even have laws and regulations? I ask myself sometimes. Oh my God, I love you guys. Man, you guys, you have no idea. You know, it's really hard being a content creator. It's harder than I thought, you guys, because I'm caring. I want to give you guys good content, and it really gets overwhelming sometimes. And I know I'm just whining like a little baby, and I'm really sorry. I don't mean to whine, but it's like, y'all, help. I just really want you guys to know like how much you guys keep me in the game. You guys keep me in this game because I really love you guys and what you're saying and how you're learning. But yes, don't worry, you guys. Bail-ins are going to be transitory. Just like inflation, right? Right, focus, just like inflation. I got nothing for you, man. Nothing for you, man. Look at this. Look at it. I guess a lot of people weren't sleeping last night. Maybe because we're the suckers, Matt. I don't know, man. But it does feel that way, Matt. And what I'm saying is like, I think it's our feelings, dude. I think we're going to be okay. As long as we're strong and you know, educating ourselves and prepare. Geez, the 10-year is just, oh my gosh, the 10-year is down 26 basis points. 10 years down 26 basis points. Let's see here. Exactly. This is what I was trying to say. You see? Hyper Beast J, he gets it. Okay. This is just going to incentivize other banks to make risky investments with no consequences. And that's exactly right. It is exactly right. We're talking about commercial lending. We're not talking about residential. This is commercial lending. There's a lot more risk involved. And people know that. So the risk and reward is supposed to be there. There's supposed to be natural event, bust, boom, bust, boom. But the Fed is trying to cram that black swan back into the box. But Hyper Beast J, we're not going to forget that, right? Okay. I can't bring up the stolen election consequences, MB. You know, I'm not saying it was stolen. I'm not saying it wasn't. I just don't want people to like freak out and like lose it because their emotions are like really hypersensitive. And I just got done saying that I am not a political person, not at all. And I don't want to talk about politics. I think it's complete crap. I look at it as, you know, WWE, Worldwide Wrestling, where Hulk Hogan and Undertaker are always fighting, right? The wrestlers are always fighting, but it's fake. When the camera goes off, The Undertaker and Hulk Hogan are best friends. They're best friends talking about how do we entertain the audience next. Same thing with politics. Unfortunately, Celeste two evils, and I'm not going to go there. That's what's up, Jeremy. Thank you. You guys hit the like button real quick. Hit the like button real quick. Do your boy a favor. You know, I did this live super early. You know, I'm exhausted. We're almost in it for 2 hours, but you guys do me a favor. Hit the like button. Okay, let's see here. Not even thinking about raising rates. That was the narrative. Oh yeah, not thinking about raising rates. Okay, I just threw that comment up there. I didn't have time to process it. Sorry about that. Appreciate you, Kim. I want to hear back from you, Wolf. I want you to go down to the SVP branch. Take some pictures, and if you can, email them to me. If you give me some boots on the ground, Wolf, I would definitely appreciate that, man. I don't know if you're set up to come on video as well, but I'd love to have you on the channel to tell us what you saw when you did that. Am I staying live for the Biden speech? I'm not, man, because that's about an hour away. And you guys see all the lights in my background? When those lights go off in the background, you guys can see that right there. When those lights go off, it means that I've been talking too long. I may go back on for the speech. I don't know. Yeah, that's exactly what, yes, it doesn't, okay, banks crashing is a spectacle, but how does it help me as a first-time home buyer? If anything, won't it make the prices of houses go up or create more fear, demand? Yeah, it will. Yes, it's going to be more inflation. And not only that, this is what you need to look at, Robbie. Right there, at 10-year. That means rates, that affects residential mortgage rates. That bad boy was around 4% a few days ago. It's down 23 basis points. This is bad. Okay, that's bad. We don't want that. So we'll have to keep watching. And then what I'm saying is that's temporary. Let me be clear about that. I think it's a trap. I think it's temporary. All right, let's keep going here. Guys, I'm about to wrap it up here. Let me see if there's anything else. Okay, here's a good one. Okay, so here's a good one. Living in Omaha. I've talked to him a couple times. Good questions, Omaha. All right, let me just make sure. Let me scroll down here. Who else we got? Okay. So how do we explain some markets that have multiple offers, especially below the 300,000 price point? So first of all, there's buying demand pin up on the sidelines. We're going into buying season. So there's going to be a seasonal increase in demand, but not from normal people, from well-qualified buyers. And I'll relate this to St. Louis. So in St. Louis, they're getting multiple offers and people are going over asking price in St. Louis. So I've analyzed St. Louis, right? I don't know. So I'm talking about St. Louis. I would have to analyze Omaha, as would really anyone, to understand local housing market. But I'll tell you what's going on in St. Louis compared to what's going on in Austin, because living in Omaha, let's not act stupid. We know that there's price decline happening at historic levels across the nation, especially in California. That's down 20% in many areas from the peak. Austin down significant amounts, Boise down. So we don't want to play stupid, right? We want to be careful with our narrative and not act like only what's happening in your market is the entire country, because that's not true. All right. And that's why I constantly tell people, local housing market, understand it. So anyways, back to St. Louis. What I'm seeing in St. Louis, specifically in Jeff's tiny little box, his tiny market, there's like no new construction. There's almost no new inventory coming onto the market. That's one. Number two, it's one of the only places in the area of St. Louis that's still under 250. So we're talking about an area that is still comparatively affordable compared to other areas. So we're talking about an area that's still affordable compared to other areas with no new construction. And what I see happening in places like St. Louis is these well-qualified buyers are like, you know what? Screw it. Let's get off the sidelines and let's just jump right in. And the thing is, David, I believe, just like last time, that's only gonna last for so long. There's only so many people that can afford to buy, and there's only so many people that are willing to. So many people can afford it. So many people are willing. Once that dries up, it's done. But that's what I believe. That's how I would explain it. There are still areas, you guys, that are not experiencing. There are still some areas that didn't have like a massive migration boom with no new construction, still relatively affordable. Now, that's St. Louis. Let's talk about Florida. Okay, because Florida is its own thing. And that's the thing. Also, I'm not knocking you, Omaha. I really appreciate you, brother. I really do appreciate you. But what I'm saying is this is all about local housing market. So Florida, I see, is a different situation than the parts of St. Louis, because Florida does have, in many areas, not all, but in many areas, they have a lot of new construction. But Florida has remained incredibly resilient to the quantitative tightening. And the reason that is, I believe the reason that is, as far as Florida, is the migration. The migration into Florida and speculation and second home purchasing. It's just like, if you want to invest in a second home, no matter where you're at in the US, you're going to buy a second home. Or if you want to speculate or vacation home, whatever it is, you're going to go buy that in Florida. It's like everyone's going to go buy that in Florida. Everyone buys the second home speculation, Airbnb, short-term rentals in Florida. And it's the top state of migration. So even though Florida has boomed and is very overvalued, I think that the resilience right now, I think it's going to fall apart. Don't make any mistake. I think St. Louis is going to fall apart in some fashion. I think, and no, Florida is going to fall apart, but I'm explaining why it's remaining resilient right now. And how long has quantitative tightening been going on? A year? Things take time. But with Florida, you guys, I see the migration and I see investing demand. Number one, migration, high investing demand, and it's absolutely crushing the locals, right? And again, it's really easy to like fall into some of these narratives when we stop thinking about how priced out the locals are. But when we start taking into consideration fundamentals and we start taking into consideration how priced out like all of the locals are, it starts to make more sense that this is not going to work for very long, right? And I think that, and I could be wrong, but that's what I think. I'm sorry, was that a little bit of a rant? So let's see here, you guys. Let me see if there's anything else. I got to get going here. I got to charge those lights behind me. I got to pull up that 10-year here in a minute. But that's about, let's see here. I think that's about it. Okay, take a look at this. Okay. All right. So look at, so here's kind of like the other side of the coin a little bit. And I think we should take, obviously many things into consideration here. Okay. I'm just going down these comments real quick just to catch up. I'm just really scrolling through this here. Boom, 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 boom. Okay. So Kevin, I respect what you're saying, Travis. Thank you, Kevin. I appreciate what you're saying. But if hyperinflation occurs, it already is, and stagflation, you might want to have hard assets. Would housing at this level not be cheap in a month or two of hyperinflation? Bro, well, oh my God. It depends what that, I mean, the thing is, if rates go back to 2 and 3% and maybe stay at 2 and 3% and wages, kept pace with all of this, then maybe. But the thing, Kevin, is I don't think it's really easy to think that investing in housing right now is the hard asset. But again, this is what I'm saying. Let me go back here. All right, to Kevin. Okay. If you put money in housing right now, you're going to be doing it at the biggest, during the biggest. Look at this run up. Look at this 2-year run up in home value. Okay. You're going to be investing in real estate when it has been absolutely squeezed out of all of its profit. It has been blown up to a historical amount, breaking every single fundamental. That is what you would be investing your money in. And Omaha, realtor from Omaha, like, I hear you, but brother, you're a realtor. Your job is to sell houses. So obviously you're going to lean towards that. No disrespect to you, but this is my point right here. If we invest, we are investing in overinflated assets that broke fundamentals, right? So I think that, but again, I think that there would be some people that have that same philosophy. In fact, I know that there will be, and I think some people will be going back into the housing market, will be jumping the gun. I think that's going to put prices a little bit higher. I think that's going to take inventory down, and I think it's temporary. I really think this is temporary, and I think that we need it to be temporary because the entire system will be much worse. Centralized digital currency. I don't know if you Omaha or the realtors understand what I'm saying when I'm talking about centralized digital currency and a depression from hyperinflation, right? Or stagflation, whichever we want to look at. We got to keep looking, right? We got to keep looking. Okay, house values overpriced. If people keep investing, what is that going to mean? It's going to mean that house values are going to keep going up, and we're going to be in the same situation, except now rates are 2 times, 3 times higher, which means what's likely to follow? Foreclosure wave. So someone's going to pay this bill. It's only a matter of time. It's canary in a mine. I think you guys understand that. But again, this is just my opinion. I could be completely wrong. They could flip tomorrow, start the money printing machines, and make everything much worse. That could happen. Right? But again, we really need to pay attention to multiple things here, guys. I'm telling you guys, please listen to me. When it comes to real estate, you must understand your local housing market. My local housing market is different than St. Louis or Omaha's, right? I mean, Houston, it's different. Different things happening in St. Louis. It's holding value for different reasons than Florida, right? Please, guys, you have to understand we need to look at our local housing market, but we also need to look at the big picture, because the big picture is going to eventually, and it is already affecting some of us. So you look at hyperlocal market, even as local as subdivision. If you're going to buy in real estate, my idea, what I'm going to do, because I'm not a financial advisor, what I'm going to do for myself is I go so I know about hyperlocal. I go so hyperlocal, I do market analysis on the subdivision. the property's subdivision, because not all subdivisions are the same. So it is hyper local, but you guys also have to understand what the Federal Reserve is doing. Okay, let's look at futures real quick, you guys, and then good. This is good. This is good. This is good. Take a look, you guys. Futures down big. Shocking. This is crazy. Futures down big, yet the 10-year is also down massive. Futures aren't even down that big. A little bit. Dow's actually down pretty decent. Holy smokes. To me, this is saying, yeah, this is a black swan and people are worried, and the collapse may be right around the corner. I'm not joking with you guys. Look at the market. The market started positive. Now it's down massive. I mean, it's down. This is crazy. The future started positive. Look at. I mean, it started positive. This is a substantial change. They may have found out something that we don't know, right? But futures are down, you guys. 10-year is plummeting. This is dangerous. This is territory that makes it dangerous. 3.4 is dangerous. 3.3, 3.4 is not where we want it. This is a dangerous time. This is a dangerous time for anyone that's investing right now. In toxic stuffs. I'm not going to answer that, David. I'm not going to do any politics, man. I respect my viewers too much to play politics. And even I mentioned someone just left the chat because I mentioned what someone else said about politics. That's how triggered people get about talking about politics. My grandma always said, and my mom always said, don't talk religion, sports, and politics. That's what she said. Damn, Vital. Crazy, right, Vital? I just don't believe it. I think that it can certainly be possible. We can certainly head to socialism, especially going down this path, but I don't buy it for a second. I think people are going to get trapped, and the people that are trapped are going to be paying the real bill. I think the non-wealthy is going to be paying this one, man. And part of those people are the recent buyers. Let's see here. Dow down 300 points. This is pretty spectacular. You guys, it's not a ninja loan. I know that Scotsman guide labeled it ninja loan because it sounds cute. It's called Nina. Okay, there is no when as a loan officer back in 2002, it drives me crazy when I hear ninja loans, because it's called Nina and CISA. If you look at the legit products and guidelines and pricing, but it's basically stated income. Do I see the return of stated income? No, I do not. But dude, I didn't think that the Federal Reserve was going to bail out Silicon Valley either, and that the 10-year was going to drop this morning 23 basis points. So we can all be wrong, and that's why I keep telling you guys, you need to make up your own mind. Don't let me do the thinking for you. Don't let anyone do the thinking for you. But I don't see that, man. It would be so stupid if it did. Okay. Let me just throw up Richards Be Happy's comment. Cash is trash. I don't agree. I would say cash is king. But I threw this up here because he's investing in silver. All right. So this man, we got someone investing in tangible asset, which is silver. So he's debanking himself. I think that probably will be a solution for many people. But I definitely would not. Hey, if you think cash is trash, send it my way. Send me up a super chat, my man. Richard, send me up a super chat, bro. I don't think cash is trash, but if you do, I'll take it. Let's see here. John. So John, great channel. Thank you, John. Here's the thing, brother. A lot happened. I haven't been able to process. Riddled with inaccuracies. Too long for the comment section. Just make a video, John. Make your own YouTube channel, brother. Please. That would be helpful. That way I can watch you. You don't have to watch me. And you guys, again, I did the best I can by referencing the articles going back to 2008. I mean, there's just so much happening right now, and there's so much to still process. It's a lot. It's a lot. And I don't think anyone knows what's going to happen. Mitch fell down the stairs last week. When to buy a home. That depends on you, right? And that depends on when we get the reset. You guys are going on about the Biden speech. Okay. Everyone is being made whole again. Why is he so upset? It's too early for that. I can't. Just rewatch the video, Moxie. Everyone's made whole again. Well, the people in Idaho, I'm sorry, the people in Ohio aren't. The people in Ohio aren't made whole again. The toxic train derailment that they're waiting to be bailed out, right? They're not made whole again. Are they, Moxie? Did they get money? I'm not sure. Maybe they got money. Maybe we're all whole again. But I see the rich being whole again. And Moxie, again, going back to what we were reading, remember the average deposit was $1.1 million. So I don't know if you're saying that who's everyone? The ultra rich? Is it the ultra rich? I'm not sure what you're talking about, Moxie. But thank you for putting that up there. Boom, 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 boom. Real estate is local. Yeah, look at this, guys. Did y'all see the commodities as well? Let me see. Jeez, look at, just since we've been on this live, look at gold and silver. Massive drop now. Look at this, guys. This is a massive drop right now, pre-market. Okay, so it's kind of spiraling now. So it's spiraling right now. Look at the losses right now. We're down 375 and the Dow, S&P down 44 or 1.16. NASDAQ down also 1.03. So it's crashing a bit right now. That's what a circus show is going on right now. So the market is not doing well pre-market. We're going to open in about half an hour now. Silver and gold doing well. So I wonder, let me ask you guys a question. Comment below, okay? How many people do you think is going to pull their money out of banks today? Comment below, you guys. Let me go to the bottom here. Do you guys think that, there's going to be a whole bunch of people that withdraw their money from banks? I do. I think there's going to be I was actually wondering how many it's going to be. Okay, good. See, another man. Good. Debanking. Yeah. And this is true. Quantitative tightening is a major cause of the current problem, because that quantitative tightening, all of those startup companies, when the rates went up, obviously the Fed is burning money. They needed more money. So quantitative tightening, they lost some liquidity, so the quantitative tightening is partially responsible for this, but also, big dog, don't forget this, the quantitative easing is the root of this. Or we could say COVID is the root, but the quantitative easing was actually the root of all of this, right? The low interest rates and things like that, mortgage-backed securities, things like that. So, wow. Look at this, you guys. Again, when we first started this, this was green. I think the NASDAQ was down slightly when we first started. Look at this, you guys. Look at this new article right here. Okay, so this is what Goldman Sachs is saying right now. Okay, so Goldman Sachs is saying there's going to be no rate hike. Okay, so SVC rescue means that the Fed won't hike rates in March, says Goldman Sachs. Dang, that's crazy. Can you guys imagine? So again, Goldman Sachs is saying and thinking that no rate hike on the 22nd. What do you guys think? Tell me if you guys think there's going to be a rate hike. I said I don't think there's going to be a 50. There should be a 50. I think there's going to be a 25. Exactly. I'm not sure who you're talking to, Richard, but you're right, Richard. FDC is not 100% guaranteed. That's a fact. They insure up to 250,000, and they only have They have less than 2% of assets of the money they insure. So it's not 100% guarantee. I definitely agree with you on that one. Okay. No rate hike would be crazy. Probably 25. Should be 50. Probably 25. No rate hike. Look at superior outlook. So I'm telling you, there's going to be people that pull their money out today. That's going to happen today. And maybe that's what we're seeing in this market. And maybe we're seeing, again, that 10 years dropping. Maybe we're seeing that 10 year dropping because that's the FDIC selling treasuries. Maybe that's what it is. Hyperinflation and no rate hikes. That's exactly right. So we still have hyperinflation. CPI is coming out tomorrow. I mean, I guess if CPI comes out and it's not hot, but seriously, guys, do you guys think, I'm telling you right now on my channel, CPI is coming in hot tomorrow. I'm telling you guys. Maybe it's not. Maybe it's not. Look at another person took out 2 million out of the banking system. They debanked 2 million. Okay, this person's switching from a bank to a credit union. Yeah, yeah. This is, I don't know who, right? I don't know 100% who you are, man, but I like you. You're right, dude. It's the most uninsured bank. Only 8% of the deposits were insured, and they got the FDIC benefit. We can't make this stuff up. Don't forget, we can't count on people. We can't trust these people. CPI will be hot. No rate increases. I think the stock market is absolutely going to crash. I don't know if that's going to happen today, but it's possible. I don't know if that's going to happen today. You know, let me go back to the futures and see what we're at. Jeez. Gold and silver rallying, futures down. Biden speaking shortly. Oh, I think, is Biden speaking right now? Oh. You guys want to watch? You guys want me to stay online and watch this Biden speech? I don't know if, man, I don't want to get political, you guys. Comment below. Let me know if you want me to stay online. I can stay online a little bit more. And let me know if you guys want to see the Biden speech, because I can play that speech. Oh my gosh, he's talking right now. Let's just take a look. Let me share my screen. Let me share my audio real quick so you guys can hear this. Okay.
Protecting the economic gains we've made together for the American people. Thank you. God bless you. And may God protect our troops. See you in California.
Mr. President, what do you know right now about why this happened? And can you assure Americans that there won't be a ripple effect?
Do you expect other banks to fail, Mr. President?
He what?
Should all the...
Oh, what? That's it. That's the speech. He gave an 8. I'm not going to get political, but the freaking speech is over. My bad, y'all. My bad, y'all. Oh, I want to talk. I'm not going to talk to politics. We missed the speech. It's only 8:06. How did we miss the speech? How did we miss the speech? And he walked out. He walked out. What did he say? What did he say, you guys? What did he say? Let me see if I can rewind it. I think I can rewind it. We're gonna listen. It was a 5-minute speech. You guys, let's listen to the speech. I'm gonna try to get you guys the speech back. That's crazy. Let's see what it did to them. Maybe that's why the futures went down. Oh my gosh. We can't make this stuff up, you guys. All right, here, I think we got the speech. Let me go back here. All right. It wasn't even a full 5 minutes. Let me, oh my gosh. Oh my gosh, where is it? What? Okay, that's interesting. Well, I don't know if I can get you guys the speech. Let me take it off for a second here. This may be this. No, this is Rihanna's wealth. No, this isn't the speech. Let me see if I can get you guys a speech real quick. Just since you've hung on for so long, 2 hours and 17 minutes. Let's see if I can get Biden's speech here. Since we missed it, apparently, must have been really important. I can't even find the speech right now. So Austin heard the speech. I didn't hear the speech. Here we go. Can we please hear the speech? Well, you guys, this is going to take, I can't easily access this speech right now, and I don't want to just keep you guys hanging. So he blamed, okay, so this person said, did they give us did he say anything productive, anything valuable about like what's going on, what they're going to do about it, or because I understand they just blame people. That's messed up, Richard. I'm not throwing that up there. That's messed up, man. I think it's funny, but I'm not throwing it up there. He said, "What is money?" and concluded. No way he said that. No way he said that, you guys. So here's a little bit of what he said. He's saying that the banking system's safe. So he got up there, talked for a few minutes, said the banking system's safe. Don't worry. Everything's going to be okay. But it doesn't appear that there were any details provided. So very, very interesting. Anyways, guys, I'm sorry. I am sorry. I was hoping this was going to come up here. But anyways, you guys just remember, what we went through today. Let me throw this up here again. We went through the fact that the FTC did take over Silicon Valley Bank. We also concluded that Signature Bank was also taken over by regulators. And going on more, we also went over Silicon Valley Bank is the second biggest bank failure in U.S. history. The first biggest bank failure in history was WAMU. We also went over that First Republic Bank is probably going to be the fourth bank to have a bank run and get bailed out by the FDIC. And we went over the average deposit in Silicon Valley Bank is $1.1 million, making only 8% of the deposits even insurable. So a lot of people should be upset about that. And we also went over the fact that a whole bunch of people had money in Silicon Valley Bank. And here we see Roku had 26% of their money in Roku had 26% of its cash in the bank, and they lost all of it, but just got it back. And then we also went over the 10-year is down now 20 basis points. I thought maybe some of the reasons are the market doesn't believe the Fed. People are leaving the stock market to go into the buy treasuries. That doesn't appear the case now because the stock market is going down. I don't know if it's crashing yet per se, but the stock market's going down. So what this tells me is there's more than likely the FDIC is selling the treasuries from Silicon Valley, but I'm not 100% sure, but that's what it appears. And then we also took a look at futures as well. And it looks like unbelievable. It looks like they've rebounded about half in just a few minutes after the speech. So, wow. So after Biden's speech, so far pre-market, they cut half the losses. So Biden says America could have confidence in the banking system, and he dipped out. I guess that is all people need. We try to do the speech. We also went over the Emergency Economic Stabilization Act of 2008, or rather the $7 billion Troubled Asset Relief Program, or TARP. So we went over that as well. We also went over the fact that TARP only invested about $236 billion in over 700 banks during 2008 bank bailout. And we talked about how 10% of that, $25 billion, is going to be printed without any votes from Congress over the weekend. Not really fair. We went over some of the banks that got bailed out last time: Wells Fargo, Bank of America, Chase, $25 billion, $2 billion, 15, 20. So we went over that. We went over the fact that Dodd-Frank Wall Street Reform Act was not supposed to allow bailouts anymore because they wanted to protect taxpayer money. They wanted to protect our taxpayer money. They said that was a priority. Protecting our money was a priority. But we also learned that they rolled back the Dodd-Frank Wall Street Reform Act in 2018. Okay. And it deregulated a lot of the protections in here. Okay, we learned that. And what else did we learn, y'all? It's been a long morning. Oh, yeah. We also learned what they're trying to sell us. And basically that it's not a bailout, that the taxpayers are not paying this. But again, you guys, the reason why they're doing this is to create a calm, and that's what they're saying. They're going to protect the depositors. But the reality is this is a bailout. From any logical standpoint, it's a bailout. They're bailing out the rich. Again, meanwhile, the people in Ohio, the families in Ohio, with all the emergency health situation, are just left there rotting. But over the weekend, they just bailed out a whole bunch of rich people. So it is what it is, you guys. Either way, do me a favor, hit the like button, you guys. I'm going to try to put out a video this evening. I'm not sure if I'm going to be able to make it. I got a ton of work to do, but from the bottom of my heart, again, you guys, you always know this. I do appreciate you following along with me on this journey. And if you're out there investing in real estate, I wish you luck and I hope you win. Obviously.